Yeah. All right. Good afternoon. It's a real pleasure to welcome you all at our conference at Charles University. So Prague is a beautiful city. I hope that some of you who arrived earlier had the pleasure of getting to know it better. And now let's start the 2 days that we will get to know each other better, and we will get to know better the latest research findings on country by country reporting. So Prague is a nice city. We are at one of the oldest universities in Europe. I think it's mid 14th century, and this is the seat of the university. This is where it started, if anybody remembers from back then. And Prague is also the capital of Europe. This is a half a year. So Czechia has the rotating presidency of the European Council. So another reason to be here. We have our Corptex research group, many members here, and we have great partners, EU Tax Observatory, why we can all be here today. And so let me thank the organization team briefly, led by Julia, Miroslav, and Sarah Godar, who cannot be here because she's ill. But many thanks for to you that we can be here. And if you need anything practical, we can get in touch with one of us throughout the conference. Because I have still a few minutes left, according to the program, and so welcome you. So let me indulge in some research findings too, and let me indulge in my personal history. So many of you have worked with country by country reporting data and followed the developments over the years, and for longer than I have. But I've been around for a while, and when I started working on tax havens and financial transparency and multinational corporations in 2009, during my studies in Oxford, country by country reporting was a phrase, was something including me put into the conclusions of their papers, kind of saying so maybe if we have country by country reporting, everything would be better. Or I used to work with Tech Justice Network on Financial Secrecy Index that tracked how countries are financially transparent. And country by country reporting was one of the questions. And for all the countries, there was 0 points getting for this country by country reporting. But here, only something like 13 years later, we are here, and country by country reporting, CbCR, is no longer only in the conclusions of the papers, but it's kind of in the titles of the papers. And there are many countries who are not only collecting the data for country by country reporting by large multinational corporations, but they are also publishing them. And I think a week ago, Australia shared the news that they will require companies to share the data publicly. We're all expecting that some EU CbCR data will be publicly shared in a few years' time, and some companies are sharing it voluntarily. Some governments are sharing it with some researchers, and I'm very much excited about the fact that we have brought most, if not all, of researchers or members of the teams of researchers who have access to these confidential firm-level CbCR data to Prague, and that we have them in this room. So there are teams from Germany, Italy, France, United States. So, it's great to have all of you here, including representatives of these research teams. So these are exciting times, as we will hear in one of the keynote lectures from Kim Clausing tomorrow, in terms of policy, that not only country by country reporting is changing, but the taxation of multinational corporation is changing, and very much looking forward to that keynote. And later today, we'll have Kim Belitska telling us what do we know about multinational corporations, so looking back and the status quo. So let me, if I still have some minutes left, I do. So here's a graph where every of the bubble is a country. And on the horizontal axis is effective tax rate. And on the horizontal axis is vertical axis. There's a profitability, profit per employee. So this is a basic descriptive graph using the aggregate data published by OECD. And one of the things why CbCR data is great is that there are so many of these bubbles. So if you did this graph and we did it with the BA data, Bureau of Economic Analysis, or some other data set, there would not be so many countries because the data is not being collected, published for that many countries. So the fact that the data is collected for so many countries is good in itself. And of course, then there are the discussions how high quality the data is in CbCR and whether the size of the bubbles or the location of bubbles is the same. But still, kind of, if you look at it one way or another, I think it's clear that there are countries, tax havens, that have extremely high profitability and extremely low effective tax rate. So that's one of the consistent messages coming also from the country by country reporting. One of the other research questions, all-time research questions that has not been settled as far as I know, even with the current country by country reporting data, is how large the profit shifting is. And so, the estimates differ widely. But what's new again is that there are some new estimates using the country by country reporting data, including, I think it's the second one in row, using the firm level CbCR data from a paper that Florian will present in about 5 minutes to us. So CbCR data, this is one of the research questions where it's been useful, although I understand the research question is not settled yet. And whether you use country by country reporting data or other data sets, this is one of the famous graphs from Gabriel Zuckman in a joint paper with Javier Garcia Bernardo. So here we see that although there's more and more research and more policy action being taken against corporate tax avoidance by multinational corporations, the problem, if anything, doesn't go away or is getting worse over the past 10 years. So this is the share of foreign profits that is reported in the selected tax haven. So it's large and staying large over the past few years, despite the Tax Cuts and Jobs Act reform in the United States. So these are some selected findings using the mostly aggregate country by country reporting data. But with colleagues, including in a recent paper with Frankie Hecker, we looked at country by country reporting kind of more broadly, and we see that even though the data is not perfect, there are some benefits that are tangible already. And we see, and we can see that in many of the research papers that you will be presenting. So if I take the final point on this slide is that the CbCR itself, the regulation requirement to share this data, does imply, seems for some companies, that they do less tax avoidance. They are paying higher effective tax rates. They are making less use of tax havens. So we will see papers in one of the research sessions that document this in detail. And it's also especially the long history of the CbCR for banks. It has provided hopefully some learning experiences for the other CbCR standards, especially BEPS Action 13, which is what we'll see a lot of research about. And so we also see, due to this bank's requirement, that it's not necessarily very costly, I would argue, for companies to do this reporting, which was one of the arguments against CbCR. So these were just, few brief mentions, and I understand that all of you basically who are here are doing more and better than what I just presented, and that's why we have a 2-day conference, which I'm very much looking forward to. So let me step aside and invite Panos as the moderator of the first research session. And I'm not sure where you will sit, but yeah, and we will have, before we proceed with the research session, we'll have a few housekeeping rules from Melstov. So thank you, and it's really a pleasure that you've traveled all the way here, and I hope that we will all enjoy. Thank you.
Thanks a lot, Peter, for the introduction, and thanks so much for coming. Welcome to Prague. It's such a pleasure to have you here. Just a couple of organizational points before we get to the full program. The research sessions, there is 2 of them today. If you look at the programs that are in front of you, each paper will have 25 minutes. So there's about a 20-minute for presentation and 5 minutes for Q&A. We will have the next break, the coffee break, at 14:30. That will be next door. We'll have to clear those codes first, but that will be next door. Then we'll have the keynote. And then just after the keynote by Kat, we'll have a little photo shoot. So before we get to the next coffee break, we'll move towards the big room over there, where we'll take a group picture. So don't run away just after Kat's keynote. And that's about it. The optional guided walk after the policy panel at the end of today's program will be led by Dan and Marek, who are sitting over there. Dan in particular is very tall, so you should not have trouble getting lost on the way to the restaurant, which would be a pity. It's a very old pub where we're going. It was founded in 1499 and has been operating since then. They brew their own beer. It's a nice place. So I'm looking forward to that. And enjoy the program. And Panos, please. No, or on the... Just switch the slides.
Yeah, no.
This one?
Yes.
Thank you for hosting us. I think the modalities have been said already, and it's such a pleasure being here. The first research session, it's called Global Profit Shifting, and we start the presentation with Florian Neimeyer from the IFO Institute in Munich.
Thank you very much for having me and for the nice introduction. In the project I'm going to talk about today, we are trying to analyze what we can learn from CbC reporting for the global amount of profit shifting by multinational companies. And the key feature, the key strength of this paper, of this project, is that we actually have access to individual CbC reports filed by single multinational companies. And this is joint work with Clemens Fuß, Felix Hucker from IFO Institute, as well as Stefan Kreil, who asked me to conceal that he's actually employed at the German Federal Ministry of Finance. And well, the key question we are trying to answer in this paper is how much profits are actually booked in tax haven countries and what part of these profits can be considered shifted. And it's a question that has been at least addressed in empirical economic research for the last 20 or 30 years or so. But it is proven to has been proven to be very difficult to answer, mainly due to data limitations. We hardly know anything, at least until the CbC reporting was introduced. We hardly knew anything about the global distribution of multinational profits. We don't know where multinationals book their profits, where they pay taxes or don't pay taxes. And in this regard, CbC reporting has been a huge step forward. So before CbC reporting was introduced, there were basically 2 strands in the empirical research on profit shifting. The first strand uses basically firm level data. Most of the literature relies on data compiled by Bureau van Dijk. It's a famous Orbis database. However, the problem with these kind of data is that it comes from public registries. And there are many countries, especially tax havens countries, who do not collect public registries and who do not publish the data that they collect about the activities of multinational companies. So if you take a look at the Orbis database, and I think this problem has been well acknowledged, you find no information about the activities of multinational companies, for example, in offshore Caribbean tax havens countries like the Cayman Islands, the British Virgin Islands, and you hardly find any information about activities in many European tax haven countries such as Malta, Cyprus, and so on as well, which I believe to be very important countries for multinational companies who try to dodge paying taxes. There are other studies who employ country-level data in order to assess the amount of profit shifting. However, as far as I know, these kind of studies is typically restricted to US data, and they make use of data compiled by the Bureau of Economic Analysis in the United States. And so in this project, we employ country-by-country reporting to basically answer an old question that has been long out there. And the key strength, as I told before, is that we were granted access to individual CbC reports filed by multinational companies. I guess you're all familiar with CbC reporting. It has been introduced in 2016 as part of the OECD project against base erosion and profit shifting. These reports provide a complete coverage of economic activities of multinational companies in case they meet a certain revenue threshold. They must have annual revenues of at least 750 million euros per year in order to be obliged to file a CbC report. And most importantly, it's a complete information. The information is complete, so you know. You have very detailed information at the country level about where they book their profits, where they pay taxes, how much taxes they pay, where their assets are located, and also where they employ their people. And this also includes information about their activities in tax havens countries. The problem with CbC data so far is that it's only made publicly available by the OECD at the aggregate level. So we don't know anything about, so the individual CbC reports are not published. They exchange between tax authorities in case a multinational company has a tax presence in a particular country. However, these tax authorities do not make them publicly available, not even in most cases to researchers. For a project that we conducted on behalf of the German Federal Ministry of Finance, however, we were granted access to the CbC reports filed by more than 3,600 multinational companies. And this includes all multinational companies who are obliged to file a CbC report and have a tax presence in Germany. That's not only German multinational companies, but also firms like Google, Apple, and so on and so forth. Every firm who has a tax presence or at least a subsidiary or permanent establishment located in Germany. And by means of this data, we basically try to answer 4 research questions. The first is there an imbalance actually between the global distribution of real economic activity on the one hand and the global distribution of corporate profits? Such an imbalance is typically considered as an indication of profit shifting if it's at the expense of high tax countries. The second question we are trying to answer is how sensitive are the profits of multinational companies with regard to tax rate differentials between countries. The third question is how much profits are actually can actually be considered to be shifted to tax haven countries. And the fourth question is we're also trying to shed light on which channels are used in order to shift profits to low tax countries. However, this is a little bit tricky. Answering this question is a little bit tricky by using country-by-country reporting data. So let me tell you briefly a few things about the data that we use. I guess you're all familiar with the setup of country-by-country reporting. So these country-by-country reports typically consist of 3 tables. And we here employ information about included in the first 2 tables of the country-by-country reports. In the very first table, you have basic financial information, basic information about the global activities of multinational companies. And this information is reported at the level of the countries of residence. So you will find information about unrelated revenues, so the revenues through sales to third parties, about related revenues, so revenues generated through sales to affiliated firms. You will find information about profit or loss before income taxes, and you will also find information about the taxes they pay in their residence countries, as well as the number of employees and the value of tangible assets for each tax jurisdiction in which they have at least a permanent establishment. In the second table of a CbC report, you find basic information about the activities of the single subsidiaries of a multinational company and its permanent establishment. So in the second table, you will find a complete list of all subsidiaries and permanent establishments, and then the firms are asked to indicate what business activities these subsidiaries perform, differentiating between 12 different business activities, including activities that are considered to be particularly conducive for profit-shifting activities, such as holding or managing intellectual property, internal group financing, or holding shares or equity instruments. So our sample includes, as I said before, all the CbC reports filed by all multinational companies with a tax presence in Germany. This includes more than 3,600 individual companies. The years covered by our samples are range from 2016 to 2019. So we have 4 years of data. And since not all firms in our data set were obliged to file a CbC report in every year, the data that we use, it's a panel data, but it's slightly unbalanced. The main variables that we use in our analysis are pre-tax profits, the taxes the firms pay in their single residence countries, intra-firm revenues, employment, tangible assets, as well as the indicators of different business activities. And altogether, our sample includes more than 8,000 CbC reports, and the firms included in our sample are active in almost 240 tax jurisdictions. So the number of tax jurisdictions exceeds the number of countries in the world, because every jurisdiction, every region with its own tax rules is considered a separate tax jurisdiction. For example, the British and French overseas territories, they are part of the United Kingdom or part of France, but they have their own tax rules. So for CbC reporting, they would be considered separate tax jurisdictions. And the sum of global revenues of all multinational companies included in our sample amounts to roughly 9 trillion euros, which is half of the nominal US GDP of 2019. So here you see the distribution of headquarters countries of the multinational companies included in our sample. Most of the companies included in our sample have their headquarters in North America. So we are not allowed to report results at the country level, but I think it's obvious that most of these here are located actually, have their headquarters actually in the United States. 24% have their headquarters in a European Union country, excluding Germany, and roughly 12% have their headquarters in Germany. So let me come to the first question that we seek to answer. So what about the imbalance between profit and real economic activity? An imbalance between the global distribution of profits and the global distribution of real economic activity at the expense of high tax countries is typically considered as the first indication of profit shifting behavior and corporate tax avoidance. What we see here is the global distribution of profits, and the two most important indicators of real economic activity, mainly the number of employees and the value of tangible assets across 4 different groups of countries. First group comprises countries with an effective average tax rate of less than 5%. The second group includes countries with an effective average tax rate between 5 and 15%. The third group comprises countries with an effective tax rate between 15 and 25%. In the third group, it's high tax countries with an effective average tax rate of more than 25%. And what we see here, that actually only a surprisingly small fraction of profits, at least that's what I would say, is reported in countries with a very low effective tax rate. So 7% of the global profits of the multinational companies included in our sample are reported in a in a country with a effective tax rate of less than 5%. However, if you compare that to the global distribution of real economic activity, the number of employees and value of tangible assets, you see that there's indeed a huge imbalance. So only 0.4% of all employees of these multinational firms are actually employed in low tax countries, and only 3% of tangible assets are reported there. So if you compute common measures of profitability, this imbalance even becomes more apparent. What you see here is the profit per employee by country group, and what you see here is that average profit per employee amounts to roughly 412,000 euros for subsidiaries located in low tax countries, compared to only 18,000 euros for subsidiaries located in high tax countries. So in other words, profit per employee is almost 23 times higher in low tax jurisdictions compared to high tax countries. And this huge imbalance can indeed be considered, or should be considered, as a first indication that firms indeed are using tax havens as a means to avoid paying corporate taxes. The second question is how sensitive are corporate taxes to tax rate differentials? And the ultimate question that we are trying to answer actually is how much of these profits reported in tax haven countries can actually be considered as shifted. And if you take a look at the literature and also at the policy debates, you will find that there's often the assumption that all profits that cannot be attributed to real economic activities must be considered shifted. So if you want to compute the amount of global profit shifting, you need to come up with a definition of shifted profit. What are shifted profit actually, and what's the difference between shifted profit and real profit on the other hand? And in the policy debate, or many policymakers often argue that all profits that cannot be attributed to real economic activities must be considered shifted. And that's also reflected in the OECD guidelines and in the OECD project against base erosion and profit shifting. And studies that try to assess the amount of profit shifting by means of microdata typically infer the amount of profit shifting, or they differentiate between shifted profits on the one hand and real profits on the other hand by means of a regression model. And this regression model looks basically like this. It goes back to Heinz and Rice, and there are meta-analyses showing that it has been used by more than 30 studies so far. So on the left-hand side of the regression model, you have the log of pre-tax profits. And then on the right-hand side, in order to divide profits into shifted profits and real profits, you will find the tax rate as a variable that indicates how tax-sensitive profits are, and indicators of real economic activity and country characteristics that tell you something about how much profit is actually booked there due to economic reasons. In our application, I refers to the M&E group, C to the residence jurisdiction, and T to the year. And we also estimate a model that is similar to this, but which differs from the standard empirical model by Heinz and Rice in two important aspects. So the first change that we apply to this model is that we do not estimate a linear relationship between pre-tax profits on the one hand and the effective average in taxes in the residence country on the other hand, but we use something that's called restricted cubic spline estimation, which allows us to account for nonlinear relationships between taxes and corporate profits. With restricted cubic spline estimation, what you basically do is you divide the residence countries into 5 groups, and you estimate the cubic specification for each of these groups. And the name restricted comes from the fact that at the borders, the borders between the country groups, at the interval borders, the function that depicts the effect of a tax rate change on profits is smoothened. So there's a smooth transition from one group to the next. I will show you a graph in a minute that hopefully makes this clearer. The second modification that we apply to the standard approach is that we refrain from taking the log of pre-tax profits for a simpler reason. Namely, there are studies, including ones by CAT, who have demonstrated that reporting zero profits is an important instrument of dodging taxes. So many firms pay or book zero profits in high tax countries. And if you take the log of profits and then all observations in which there are zero profits reported in the countries will be dropped, which means that it is very likely that the amount of profit shifting or the tax sensitivity of corporate profits will be underestimated in case you take the log of profits. So in order to circumvent this issue, we refrain from taking the log of profits, but estimate the tax sensitivity of corporate profits using pseudo-Poisson maximum likelihood estimation. So we obtain an estimate for the tax semi-elasticity of corporate profits without taking the log of profits. So here's the results for our estimate for the tax sensitivity of corporate profit, and this shows you how a restricted cubic spline function looks like. What we see here is on the vertical axis, the marginal effect, so the estimated tax semi-elasticity of corporate profits, and on the horizontal axis, the effective tax rates in a country. And what this graph tells you basically here is that in countries, or if the effective tax rate is 0 or close to 0, then the estimated tax semi-elasticity is roughly minus 13, which means that if a low tax country increases its tax rate by 1 percentage point, then profits reported in that country would decrease by roughly 13%. If, however, the tax rate increases, then the marginal effect becomes smaller and smaller. For a tax rate level of roughly 15%, the marginal effect is minus 5, which means that a further increase in the effective tax rate by 1 percentage point leads to a reduction in profits of minus 5%. And for a tax rate of 20% or higher, we do not find any significant effect of further tax rate changes on corporate profits. So this points to a huge nonlinear relationship, pronounced nonlinear relationship between corporate profits and the effective tax rate level. Studies, the meta-analysis I was talking about that use a linear specification typically find that on average, based on this linear specification, the estimated tax semi-elasticity lies somewhere between minus 0.8 and minus 1, which would mean that the true tax sensitivity in low tax countries is severely underestimated. So based on these estimates, we now try to calculate the amount of profits that are shifted to tax rate countries. And to do so, we proceed in 2 steps. What you see here in this table is the actual distribution of profits across different country groups. So the MNEs included in our sample report roughly 135 billion euros of profits in Germany per year, and roughly 224 billion euros of profits in European tax havens per year, and 134 billion euros of profits in non-European tax havens per year. And in order to infer what fraction of this profit is shifted into or out of these country groups, we proceed in 2 steps. In the first step, we use the results from our restricted cubic spline estimation to compute how much profit would be shifted out of low tax countries in case we increase the effective average tax rate. And here we increase the effective average tax rate to a level of 20%. Why 20%? 2 reasons. First, it's the median effective tax rate in our sample of countries. And second, we've seen before that for a tax rate level of 20%, the marginal effect, so the estimated tax semi-elasticity is not statistically significantly different from 0. So if we do that, we obtain an estimate of the global amount of profit shifting, and this estimate for the global amount of profit shifting is 240 billion euros, or 16% of global profits. So this would be our estimate of the global amount of profit shifting. So this is the size of the profits that are shifted would leave tax havens countries or low tax countries in case they would increase their effective average tax rates.
The time is up. Maybe we can leave some time for comments. Last word.
Okay. And then in the second step, we try to figure out where these profits would be reported in case there would be no profit shifting. And to do so, we take up on the idea that in a world without profit shifting, or the political argument that in a world without profit shifting, the distribution of profit should reflect the distribution of real economic activity. So we compute an indicator of real economic activity and use this indicator to reallocate shifted profits across residence countries. And when we do so, we obtain estimates for the size of profits shifted into or out of different country groups. And according to these estimates, we find that roughly 33% of the profits reported in European tax haven countries must be considered shifted into these tax havens. For non-European tax havens countries, it's 44%. And countries like Germany or the European Union do lose quite large fraction of their profits due to profit shifting. With this,
thank you very much.
Thank you very much, and I'm looking forward to your comments and remarks on this.
Just a couple of minutes for questions, if anyone has a question. Yeah.
So there's a huge reduction in estimates currently out there, right? Of what's shifted.
Yeah.
I guess a big deal.
It depends. So there are two different strands. There are macro estimates and micro estimates, and actually our estimates, well, we would place our project or our research into the strand that uses micro data of estimate. And if you compare our results to other micro estimates, we're actually at the upper end. There are estimates, there have been recent estimates, for example, by the OECD, which amount, or the OECD study concludes that the amount of profits that need to be must be considered shifted is roughly somewhere between 7 and 10%. So compared to other micro studies, our estimate is actually large. Compared to macro studies, for example, the one by Torslov and Zuckman, it would be small indeed. Yeah. So they have an estimate for the amount of profits shifted of roughly 40%. However, this concerns only the profits, the foreign profits of multinational companies. Yeah. And I think the key difference between the macro estimates and the micro estimates is that they assume different counterfactual distributions. So if you want to compute the amount of profits shifted, you need to come up with a counterfactual that tells you how would profits be distributed globally if there was no profit shifting. And I think these are the key.
Do you have a sense of where? I'm sorry. Do you have a sense of where your firms fit in the distribution? Are they the biggest company?
They are the biggest companies indeed. So
that's our concerns about it.
I don't think so, because typically what micro studies find is the bigger the firm, the more inclined they are to shift profits. And we do here sample splits and estimate the tax sensitivity of corporate profits by firm size and confirm basically these findings. The larger the firm is, the more sensitive the profits of the firm are to tax rate differentials.
If we have our bigger firms in our micro cycle, then the difference from macro shouldn't be as large.
Yeah, they're right. Yeah, that's right. That's right.
Just a quick one, because we have to move. Otherwise, I can also wait for the coffee break. Yes, I think I prefer, because the time is up.
Okay. Yeah. Thank you.
Thank you very much. And second presentation is by Gunther Capelle-Blanchard from the Paris School of Business.
Morning. Good afternoon. So actually, I'm from Paris 1 University.
All right.
But and it's a paper conferred with some colleagues. So it's about the banking sector. Okay, we consider the country by country reports to examine the banking sector. And Mona, who is here, has worked a lot on this database. So thank you, Mona, for this. You are all familiar with country by country reports, so I will skip much of the presentation to focus on some difficult points, actually. What I want to focus on the geography. Okay, I'm not sure about the previous paper, but in the previous paper, I'm not sure they take into account the geography. And I consider that it can be very important to examine tax haven. So first, I will present a theoretical model. So you know about this. In our theoretical model, first, we consider a very simple banking model. The Monte Carlo model is a very popular model to examine the market for banks. But this model is with only one country, of course. And we will extend this model with many countries. And in addition to this model, we consider horizontal FDI. To take into account what is very important in economic geography, which is the export platform. In our specification, in our model, what is important is that we consider a tax haven like a hub. And I think it is important to understand the role of tax haven. So we have some hubs. So we will not consider profit shifting, but turnover shifting. The bank, not the company, but the bank, we will use some country as a hub. So when we consider, for instance, in the previous paper, that profit shifting is when you have abnormal profits, you should consider the geography, because in a country like the Luxembourg, for instance, the country is very small, of course, but you have a lot of profits in Luxembourg, especially for banks. So you can consider first, a priori, that it is a tax haven, but maybe there is something else. The Luxembourg can also be a hub for a lot of reasons, not only because of the tax, but of course in the banking sector, because of the regulation, which is important. So in our model, we will consider a version of the Elfman paper, which is a very well-known paper in international economics, and we'll consider some export platform. And with this framework, the last ingredient in this framework is to do some profit shifting. Okay. So I will not show you all the model because it's a little bit tricky and not very interesting. I will just give you some insight and some conclusion. So it is a very classic model. A Monte Carlo model is a Cournot model, actually. It's an oligopoly, which is very convenient for the banking sector. So we have an oligopoly with identical bank. And we consider bank in every country except in tax haven, just to simplify the presentation. So we have a lot of countries and a lot of banks in each country. And each bank can have some subsidiary in other countries. But when you have a subsidiary, you have to pay a fixed cost. If you do not have a subsidiary, if you want to provide some foreign turnover, if you want to export financial services, you have to pay a cost if you do not have a subsidiary, and the cost is related to the distance. So if you want to export financial services far away, it costs more. So this is very classic, very simple. And our bank maximize their profit. Okay. So we will not consider any regulatory framework. Actually, we skip all this stuff which are important in the Monte Carlo model, but we are not interested by, for instance, the provision of the bank or the capital ratio of the bank. It is not our topic. And we have a linear demand function. So I will skip all of that. So just a fixed cost when you have a subsidiary, and a variable cost if you export financial services. Okay. So first we have this configuration. Of course, it is very, very basic in this case. If a country is closed, you do not have to install a subsidiary. You just have to export financial services because the cost of distance is very low. And if the country is very far, you pay a fixed cost. And this is the profit, which depends on the distance here. Okay, a very classic framework for the beginning. And if you install a hub, you do not have to pay a fixed cost in every country. If you want to export financial services in Asia, you do not have to pay a fixed cost in Singapore, in Hong Kong, in Macau, in China. You just need one subsidiary in Hong Kong. And then you will pay a variable cost to provide services in China, in mainland China. But the variable cost, of course, is very low because Hong Kong and China are very close. Okay, so this is in this paper what we have here. You can just maximize your profit. So it is not profit shifting. It is perfectly rational. And it is why it is important. It is perfectly rational to have huge turnover in Hong Kong, because Hong Kong is a gate for Asia. Of course, you know about that. But we try to provide a rigorous framework to discuss about profit shifting and so on. Okay. Yes, something more specific, but I will not expand. To give more flavor to the model, we try to imagine a fantasy world with only 9 countries. I will show you this fantasy world. So we have an archipelago with 9 islands, A, B, C. Okay. And to provide financial services from one country to another country, you have to pass a bridge. You have to cross a bridge. And the bridge are all equals to have a very simple model. Okay. F is the home country, like France. Okay. And each country is characterized by a size, which depend here. You can see the size. It is not only the geographical size, it is the size of the market. Okay. You have a size, you have a specific corporate income tax. Okay. And you have large T, which is the regulatory framework. Okay. Which is more or less lenient. So you have different size, different location, and different corporate income tax. We have 2 specific countries, E, which is very central, of course. So it is very important. It is a small country with a low tax rate. And we have H, which is a tax haven with a very, very low tax rate, the lowest tax rate in our world, which is also a very small country. And we will see what is the optimal strategy for a bank located at home. Okay. So we apply our model, which is an oligopoly. It's very classic. It takes a long time to do the computation, but at the end, it is very, very simple. And I will show you what happened. In this model, we have decided some specific characteristics, of course, but you can see that you will not provide any financial services from home. You will consider the help country to provide financial services at home. It is better when you are a French bank, it is better to use your subsidiary in Luxembourg to re-import financial services in France. Maybe I can repeat. Instead of providing financial services from France, you install a subsidiary in Luxembourg and then you re-import financial services from Luxembourg. And it is very well known that asset managers in Europe are in Luxembourg because the regulatory environment is more lenient. Okay. Even if you want to provide financial services in your domestic country. So the turnover at home is very low. Of course, in this model, we just consider a kind of financial services which can be exported. Okay. So at home, you have a very low turnover just to provide, to export in the country. Most of the turnover will be, most of the activity will be in the hub. And of course, the tax haven can take advantage of the very low tax rates to attract a lot of activity and then re-export activity in many countries. So we have different configuration. Of course, we have chosen some specific numbers to have a very broad panel of configuration. For instance, for the country A, which is a large country of center, it is better to have a subsidiary because the distance is too far. Okay. And with this model, we can consider different type of profit shifting. Actually, in red, it is profit shifting or turnover shifting, but you can, of course, compute the profit after that. In red, it is profit shifting, but in green, it's about export platform. And it is very difficult in the data to distinguish between the different forms of foreign activity. Okay. In the following, I miss a table, but I would say because we can compute the turnover, we can also compute the turnover if it is not possible to move. So we have a benchmark and we can compare the reported turnover with our benchmark. And the difference is like in the previous paper, the profit shifted. Okay. And in this framework, the amount of turnover, which is abnormal, is between 3 and 20, the actual turnover, between 3 and 20, which I will show you next, is the amount we find with the data. Okay. We did the estimation before, and then we choose a number to fit with the data, not the contrary, to be honest. Okay, so we consider the country by country report. I just want to mention that the first country by country report, the first initiative is from France. I'm working on that topic since 10 years now. It was in France. 10 years ago, I received a phone call, and they asked me, is it interesting for you to have data country by country? And of course, we say yes. And it takes a long time to have the data. It was a long journey. So you know that. In our sample, we consider only bank because it is regulatory data for the European Union, of course. We have some panel data. The first draft of the paper a long time ago was just with 1 year, but now we have a panel. The data are from the EU Tax Observatory. Thank you very much for the data, which are very clean. And of course, the data are limited. Maybe we will talk about that later. So we have 36 European banks from 10 countries and 138 jurisdictions, and among them, 25 tax havens. I will be very. So you have some very classic figures. As you can see, maybe it's better to see like this. If you consider non-tax haven, for instance, the amounts, it is like before, the amounts for non-tax haven, the ratio turnover on employee is very low for non-tax haven compared to tax haven. And we distinguish not with the effective tax rate, but with the size of the country, but the correlation is very high. So it is only simple statistics, some very well-known styles at last, and some cartogram to show that actually most of the tax havens in red are in Europe, very few in Asia. And the discussion is about this map. because I have to finish. In this model, in our model, we show that we cannot consider Hong Kong here as a pure tax haven because Hong Kong is mainly a hub, which is not the case of the Panama or the Bermuda, for instance. So we have to be very clear when we consider tax haven, which is not a uniform group. And of course, Piotr Jansk here is working a lot with Miroslav on that topic to distinguish between the group of tax haven, which country are hubs and which country are real tax haven. Okay, so it is very classic for the end. We apply the PPML estimator, we apply a gravity model to take into account the geography, and we measure some abnormal turnover. Okay, where are they? Okay, maybe here just one word. Because it is very tricky to measure abnormal turnover, it depends on the methodology. So we run more than 600 specifications. I was very pleased to do that. We run more than 600 specifications because you can define some different lists, you can choose different parameters and so on and so on. So 600, more than 600 estimate, and then we compare the estimate with our benchmark. And we have this distribution, and we are very confident about our estimation because, as you can see, we are not very far from 100%. For the robustness test, I'm very pleased to do that. It is the first time I did like that, but I think it's very convenient to do hundreds and maybe thousands robustness tests in only one graph. And if you consider the different country, we have for each country 600 estimation that you can see that our estimation are very, very, very the range of the estimation are there. I have finished almost. Just to mention that Switzerland and Ireland are not tax haven in our paper. Abnormal turnover are negative for Switzerland and Ireland. So maybe it is, we have two explanations for Ireland. Ireland is not a tax haven for bank, but maybe for multinational. And for Switzerland, actually, in Switzerland, you have already a lot of domestic banks. So it is difficult to enter the market in Switzerland. Maybe we can have two explanations to explain this surprising results. Okay. That's it. I think I've already.
Yeah. If you can have a final sentence, and yes,
okay.
Or we can end with this as well. Yeah.
The final sentence. It's in Europe. The main country is Luxembourg. We don't care about Bahamas and Panama. Actually, it's not important. What it is important is Luxembourg, and it is very important because we can do something. With Bahamas, it's of course very difficult. With Hong Kong, it's difficult, but with Luxembourg, we can do it. So just do it.
We have 4 or 5 minutes for discussion. Anyone with a question? Maybe I can ask one.
Yes.
Then you think that you take geography and distance between countries as one of the main parameters of the model that drive the results. And how do you deal over the years? I mean, from 2015, this has changed until 2020. As have become more digitalized. So do you take this into account? And how
no, the distance is fixed. We consider different proxies for distance. The geographical distance, of course, but also the cultural distance with an indicator like with many indicators, but one of the most famous is the common language or a former colony. You have a specific distance with former colonies. So we have, I guess, 4 or 5 proxies for distance, but all these proxies are constant.
And don't you worry that it might have changed over the course of the years, or if they change, would it affect the results, or do you think it's?
I'm not sure it is very important for the conclusion, but for the methodology, yes, it limits it's a panel data model. So if you have a constant parameter in time, it is not very convenient. But I'm not sure it is at the end economically important. Maybe one word, we could expect a change because of this country by country reports. We do not see any change in the banking behavior. So we do not attempt to do some causal analysis. So we have to be cautious. But a priori, there is no change in the banking behavior, unfortunately.
Any other questions?
Again, thank you for the data.
Because of the your paper, the tax rates are drivers for the banks to choose a tax haven, but these factors can be considered as important according to the regulations.
We do not have the tax rate in our specification. We consider a dummy which is based on a list of tax haven. Okay. Why? Because the tax rate is only one parameter. You should take into account not only the tax rate, but the tax environment, and for the bank, the regulatory environment. And unfortunately, we do not have any proxy for the regulatory environment. We could try, but they are not very well done because it's difficult to measure with one variable the regulatory framework of a country. So we do not attempt to do that, which is important to do. But in our paper, we just consider a very simple approach. We have a dummy for tax haven. Okay. Because our attempt is to insist on the geographical aspect.
Okay, with this, let's move on to the next presentation. Thank you very much.
Thank you.
Next up, we have Paulo Manuel Schuch, who used to be an ex-colleague at the observatory with a significant contribution. Now he's at the Institute for Technology.
Sorry. Hello. So my name is Paulo Manuel Schuch, and the work that I'm going to present was extracted from my master thesis, and it is entitled "Do Multinationals Unrelated Party Revenues Respond to Corporate Income Taxation?" And I will try to present both evidence about the phenomenon and also the potential implications for policy simulations. So maybe as a first word of motivation on the academic side, the literature on the corporate income tax avoidance behaviors of multinational companies has widely focused, and maybe there's been sort of a shift in focus towards the elasticity of pre-tax profits to taxation and estimates of profit shifting, often by controlling for real economic activity in the specifications. But more recently, and in a very interesting paper, Lafitte and Tubal have proposed to put another variable under the spotlight. And I would say again, because previous studies had already studied the reaction of revenues to corporate income taxation. And so they look at the sales of US multinational companies, and they show in particular that US multinational companies tend to concentrate their sales in low tax sales platforms. And the analysis encompasses both intra-group and extra-group transactions, such that in a way they encompass both profit shifting operations through intra-group transactions, but also other potential responses to taxation. And interestingly, this echoes the notion of export platforms and pure paper profit shifting that we have seen earlier. And so this would be on the academic side, but on the policy side, this paper inherits from the proposals of reforms of the global corporate income tax system that have been aiming at reconnecting the revenue generating activities of multinational companies or value creation, although it's difficult to define sometimes, but these activities of multinational companies and taxation. And so there has been, of course, Pillar 1. There is also the minimum effective tax rate proposal. Basically, any sales apportionment proposal can be considered here. And these proposals have in common that when we want to simulate their revenue effects, we need a destination-based mapping of multinational company sales. And currently, we do not have such data. And this raises the question of what the economic factors are that drive the wedge between what we actually observe, which is the accounting-based treatment of multinational companies' revenues, and what we do not observe, but that is a destination-based mapping reflecting the location of customers. So I might skip the small thought experiments that I wanted to share, but basically these two dynamics raise the question of, do multinational companies, extra group transactions or unrelated party revenues respond to corporate income taxation? That was fast. So this does not come as a surprise. This paper uses country by country report statistics. More specifically, the results that we are going to see mostly focus on the IRS country by country report statistics from 2016 to 2019. But what is maybe more original is the reasons why we use this data, because fundamentally, we are interested in the revenue variables in country by country report statistics. And they present three main advantages. The first one is that they encompass a broad range of transactions. So not only the sales of goods and services, but also royalties, interest payments, and premium. But the second advantage is that, importantly, to answer this question, actually, they allow to distinguish between related party revenues and unrelated party revenues. So to isolate the extra group transactions of multinational companies. And the third advantage is that they reflect the potential tax planning margins that multinational companies may find by organizing their extra group transactions. So say if a cloud service firm decides to concentrate for tax planning purposes all its sales to European customers in Ireland, well, the data will reflect this strong concentration of revenues in Ireland rather than the location of the actual customers. This will be, of course, a hurdle when we try to simulate policy reforms, but this is an advantage when we want to study the tax planning margins of multinational companies. So to start with some very basic descriptive evidence, we simply rank the largest affiliate countries for US multinational companies in the 2017 country by country report statistics based on unrelated party revenues. So we find some usual suspects, close commercial partners of the US, the UK and Canada coming first and second respectively. We find large industrialized or emerging economies, but we also find some smaller jurisdictions whose weight may be more surprising, like, for instance, Ireland, Switzerland, Singapore, that make it into the top 10. And actually, the tax havens listed by Tanslovia and Zuckman account for 27% of the unrelated party revenues booked by US multinational companies outside of the US. So that's what we are going to call foreign unrelated party revenues. And when we extend to other headquarter countries with the OECD's data, then we are more around 21% of foreign unrelated party revenues. So I've said small jurisdictions, but actually there was no notion in this table of local market size or local demand. So this is what we do here. We show each country's share of on the x-axis of consumption expenditures, and on the y-axis each country's share of foreign and related party revenues booked by US multinational companies. So of course we see a normal relationship indicated by the regression line that is positive, but the correlation is rather limited, it's only of 0.66. And interestingly, we see some jurisdictions that stand well above this regression line. And so we have the commercial partners that we mentioned earlier, United Kingdom and Canada at the very top of the graph. But on the left-hand side, we see that actually many jurisdictions classified by as tax havens by Tanslovier and Zuckman show a disproportionate relationship between the unrelated party revenues that they concentrate and their local market size, their local consumption, their share of total consumption expenditures. So we have two main conclusions from this descriptive evidence, which is first, some small jurisdictions may concentrate a large share of unrelated party revenues. And second, these concentration can be in complete disproportion with local demand, local market size. But we could have several interpretations for this. The first one would be to say, without even talking about remote sales, we could say it's very easy for US multinational companies to enter these markets. A lot of firms enter the market, then they book a lot of unrelated party revenues there. And this could be the case, for instance, for Ireland because of common language and so on. The second explanation could be, well, this is because of remote sales operated to other market jurisdictions and booked in the country. And so small jurisdictions may attract a lot of unrelated party revenues because of the access that they provide to large neighboring markets. And this could be, for instance, the case for Singapore in East Asia. But still, these explanations do not provide a satisfying explanation for the presence of many tax havens in these on the left-hand side of the graph with a disproportionate relationship. And so this is why this is what we're going to try to disentangle with the econometric analysis. So the model relies on a theoretical framework that comes from the trade literature. And in this theoretical framework, we shut off all possible ways for multinational companies to disconnect the jurisdiction where they book their revenues and the jurisdiction where sales actually occur, the location of customers. And then in the bilateral equation that we obtain for extra-group sales, foreign market access or taxation play no role. And so this is what we are going to precisely introduce in the specification to test the effects. And this gives the following model where we essentially explain the logarithm of unrelated party revenues based on taxation, GDP of the headquarter and of the affiliate country, the foreign market access of the affiliate country, distance, gravity control variables, and so on. So these are the benchmark results that we obtain when estimating this equation with various corporate income tax rate measures. So in column 1, we estimated with the statutory tax rate, and we find a semi-elasticity of unrelated party revenues to corporate income taxation of minus 1.85. So this estimate is rather robust to the use of alternative corporate income tax rate measures. So here I put the lagged statutory tax rate to take into account maybe the location decision timeline of the firm. There is also, we can also look at the effective tax rate computed directly from country by country report statistics and lagged by 1 year again. And so overall, the magnitude of the effect is rather consistent throughout these different corporate income tax rate measures. What is also noticeable is that the main controls that we have introduced have like the expected effect. And in particular, for instance, foreign market access has a positive effect on unrelated party revenues in the two first specifications, which may indicate that indeed the access to large neighboring markets plays a role in explaining the concentration of unrelated party revenues. And the fact that we lose significance when we introduce the effective tax rates computed directly from country by country report statistics, as is argued maybe more thoroughly in the paper, may raise questions about endogeneity issues with the idea of using ETRs that we compute from the same data that we use in our model. But so the second question that we could ask is it truly about corporate income taxation, or is it, do we have a sort of signaling effect for other characteristics of the country's tax environment? And so in this specification, yes, we introduce other characteristics of the tax environment. And in the first column, we simply introduce characteristics such as double taxation conventions, exchange of information agreements, and so on. And so we already see that the magnitude of the effect associated with the statutory tax rate and the statistical significance of the effect are already reduced. So this may hint at a sort of omitted variable bias that would inflate the benchmark's elasticity that we have computed. And then we introduce the tax haven status of the affiliate country, as well as the standard consumption tax rate for this country. And here also, we find that the magnitude of the effect for corporate income taxation and its statistical significance is further reduced. So again, this means that we might have been so far pointing at other characteristics of the tax environment of the country. So this is the main message from this table. The two others are that, well, tax havens concentrate a lot of revenues a priori, because holding other controls constant, a tax haven will concentrate up to 4 times larger revenues because of the estimates that we have here. And we also see that for unrelated party revenues, consumption taxation seems to play also a key role, and the magnitude is actually significantly larger than the one for corporate income taxation. So now that we have seen that indeed there are some responses of unrelated party revenues to either at least the foreign market access that the affiliate country may provide, also to the tax environment of the country, we see that there are some distortions between the distribution of unrelated party revenues in the data and the destination-based mapping of sales of multinational companies and the location of their customers. So this raises an issue when we want to simulate reforms based on sales apportionment of taxing rights or revenue gains. And so we do the exercise with some methodological caveats in the paper, and we find that indeed tax havens may be attributed if we were to naively allocate the revenue gains based on the revenue variables in country-by-country report statistics. Tax havens would actually obtain a large share of the revenue gains. And so that is why we propose a destination-based adjustment of country-by-country report variables based on statistics from the BEA and on trade statistics. So I might skip the methodology, but I can show you some evidence of the performance of the adjustment. So first, the adjustment completely recomposes the top 15 countries that we have seen earlier. And the most dramatic example, I would say, is Ireland moving from 3rd affiliate country to 14th position. And this recomposes quite generally in a detrimental way to small low tax jurisdictions that had a large weight in the distribution that we saw earlier. And it also recomposes in favor of higher tax countries and major industrialized or emerging economies. And if we look at the fit with consumption expenditures, we see that it is improved, that we have an improved consistency with local demand indicators. And we see that the jurisdictions on the left-hand side of the graph that we saw earlier had a disproportionate relationship between unrelated party revenues and consumption expenditures are now closer to the normal relationship. So indeed, we find that 9 of the 10 largest losers from the adjustment in terms of unrelated party revenues being moved out of the country by the adjustment are tax havens, based on the list by TWZ still. And their weight in the data has moved from 27% of the foreign unrelated party revenues of US multinational companies to 18%. again, as a mechanical consequence, I would say, when we try to simulate the revenue gains from a reform proposal, we find that the weight of tax havens in the revenue gains is reduced. But interestingly, the trajectory of some tax havens, like Netherlands or Belgium, whose unrelated party revenues actually increased with the adjustment, may point to some limitations of the adjustment, and I can discuss this in more detail. So to conclude briefly, I wanted to share maybe three messages. So the first one is that country-by-country report statistics are very interesting to study the revenues of multinational companies, and in particular, as we have done here, the extra-group transactions. The second message is that we find some evidence of an effect of affiliate countries' tax environment on the distribution of unrelated party revenues, whether it is directly related to corporate income taxation or to other characteristics, may be less clear, but we have definitely some evidence of tax-motivated location of unrelated party revenues by multinational companies. And eventually, the last point is that to facilitate further simulations of reform proposals based on sales apportionment formulas, we propose an adjustment of country-by-country revenue parameters, and the database is available online. You can also find a Python package to manipulate the parameters, and I would be very glad to talk about this in further details. Thank you very much for it.
Thank you, Paulo Manuel, for being on time as well. We have 5 minutes for questions. Someone has a question? Yes.
In particular, I did not understand the Belgium and the Netherlands case. Yes, you say you can give some detail.
So
if I understand well, the adjustment is positive for them. They gain from the adjustment.
I don't know if I can using the computer.
You can point with the laser.
But to click on the website, I'm going to directly. So in the benchmark adjustment, we see that we indeed have an increase in the unrelated party revenues booked in Netherlands through the adjustment. And what is interesting is to look at where these come from. So, oh yes, maybe the first step would be to describe the methodology of the adjustment in very brief details. So the methodology works in 2 steps. So the first one is we use BEA statistics to distinguish between unrelated party revenues that are directed to the local country, to the US, or to any other jurisdiction. So we use these data to split revenue variables in 3. And the revenues to other jurisdictions are split based on the affiliate country's exports. And so when we look at the case of the Netherlands, the first thing that we should look at is how do BEA statistics play with Netherlands. And so local sales, according to BEA statistics, accounting for 65% of the extra group sales of goods and services booked by US multinational companies in the Netherlands. So it's a reduction by 1/3, but if you look at Ireland, the reduction is much more drastic. And the second thing that we can look at is where do the unrelated party revenues attributed to the Netherlands afterwards through trade statistics come from. And so they come from the US mainly, which compensates for the loss through BEA statistics, because the Netherlands represents 2.9% of the US exports. And they also come from Ireland, Belgium, Switzerland, UK, Caribbean Islands, Singapore, Bermuda, if you look at the top 10. And so this is the main, I think, weakness of the adjustment when we look at the graph, is that trade statistics typically do not exclude intra-group transactions. And we used, by the way, trade statistics for merchandise and services. So you could have intense exchanges of intellectual property services that would be reflected, that are used for profit-shifting operations, and that leads to this sort of recomposition. But this is actually maybe the main limitation. Sorry, I was long.
Any other questions? Maybe you can go to the table with the consumption tax.
Yes.
How do you rationalize this point for the manual that is even more important, for example?
You could argue that. So in a way, what is interesting is to look at the effects of the respective effects of corporate income taxation and consumption taxation for unrelated party revenues and related party revenues. And typically, for related party revenues, we can see that a large share of the unrelated party revenues booked by US multinational companies is directed to foreign countries quite often in the BEA statistics, which is less the case, much less for unrelated party revenues. And so the fact that the local consumption tax rate plays a role, I think first is related to the fact that local consumption still plays a key role in explaining unrelated party revenues, the distribution of unrelated party revenues, maybe more than for the related party transactions. For further interpretation, I would say that in a way, this questions the idea that of whether unrelated. I mean, this tends to qualify the use of extra-group transactions as a way to manipulate for tax planning purposes. You are still, stuck to local demand and dependent upon consumption taxation, local characters.
Any other questions? Okay, we are right on time. We have a 15-minute coffee break in the room next door, from what I understand, before reconvening for the first keynote. So let's meet in 15 minutes at 2:45. It's on the right here.
So when we were planning this conference, we thought we need to attract you, best researchers in the field. So we thought we would do it in one of the nice rooms at the universities. We would have a sunny weather. We would have a nice pub promise at the end, and we also thought we need some very nice keynote lectures. And so it's my pleasure that Katarzyna Gulicka is our first keynote lecturer, and then most of you know her for her excellent research. And looking at her research career, she started with her PhD at Oxford, and then moved on to Logan at the Utah State University. And she also probably likes it in Logan because she wants us to see Logan next year. That's why she's organizing the IAPF conference there. So I'm amazed that even at such an early stage in her career, to put it diplomatically, she's already kind of giving back by providing this public good to us researchers. This is only one of the examples, the other being that she's organized these great online public economic seminars during COVID. So that's very much appreciated. And so she's doing a lot for the profession. Also, I think she's being a member of basically all the relevant academic networks in economics. So that's great too. And many of you, or maybe I first heard of Kat's research with her great paper, How Aggressive Are Multinationals in Tax Avoidance, which was later published by American Economic Review, although under somewhat more boring. More boring title, but we all know the early version, so that's you meant it well. So all in all, I'm very happy and honored to be having Kat as the keynote lecturer. And she disclosed publicly that this is her first keynote lecture. So, we wish her all the best. And I trust that this is not the last one. So without further ado, Kat, please, the floor is yours.
No pressure now, right? You're watching and waiting for me to pay out here. No, first of all, I wanted to say thank you so much to the organizers for inviting me. This is really exciting for me to speak at this conference. Of course, the subject is near and dear to my heart. So the second thing I want to say is that although the title of the conference is country by country reporting, I have actually never dealt with country by country reporting data. So what I want to talk about instead is sort of why do we really need this data? And so this is why the title of the talk is how much do we know about multinational activities around the world? Because I sort of want to take a step back and look at my own research and try to think about sort of how much I've learned through my own work about multinational activities around the world. And I guess I need to click the screen, this to work. Yes, fabulous. Okay, so really, I just want to reiterate that question because it seems pretty obvious. And yet, if you think about the fact that we're pushing so much for country by country reporting data, means that we actually don't already know that much. And so I want to reiterate as sort of how much do we actually know about firm activities around the world. And it's great to talk about this within the scope of thinking about country by country reporting data, but even on its own, it stands to say that understanding global firm networks and how they operate is key in designing tax systems that actually work. This is not what I'm going to talk about. This is what Kim is going to talk about. I'm instead going to sort of take a retrospective, look at 3 of my papers and sort of go through them reasonably quickly. And I'm going to explain to you why the 3 that I chose are relevant for the topic of this conference. But I want to say something about financial data here and sort of how much information we really get on companies and sort of where they operate in terms of unconsolidated financial information. And the three things that sort of come to my mind when I think about financial data is that financial information doesn't necessarily have to reflect real firm operations. We already heard some papers today that talked about this, so this isn't like groundbreaking thought here. And that could be due to various different things, right? Differences in depreciation rules, reporting standards, and complete data render financial information sometimes hard to sort of do any work with. But there's also things like opportunistic reporting behavior, which is a kind way of to call profit shifting, right? Firms make strategic decisions as to where to report not only profits, but also things like turnover and assets. And so in all, and this is where I close my keynote here right now, we're learning things, but it's quite a long way to go for us to really understand what's going on. And so what I want to talk about, and I promise I have 53 slides and that might sound daunting, but I did rehearse it yesterday and it's 45 minutes. So there are three aspects of profit shifting that I want to talk about. All three are based on all the recent papers that I have in this area, so sort of the ongoing work. And some of them are like the last one, very, very recent, in that we have really cool data. And, you know, this is like a sell to you to use that data as well. So the three things are, does financial data reflect real firm operations? And I'm going to talk about my Nightlight paper in brief. Then the second thing is sort of, okay, so there's profit shifting, what enables multinationals to shift profits. And then the third part, this wouldn't be a keynote in a conference about, you know, profit shifting if I didn't talk about tax havens at all. So I'm going to try to talk about tax havens a little bit, but in the context of patents and how many patents are located in tax havens using new cool data on patents. Okay. So where are firm profits relative to firm operations? So sort of what is the scale of profit shift, right? And here, it was my attempt to summarize the literature. By no means, this is a summary of the literature. This is just sort of throwing out various things that are happening in this area, thinking about contributions that have been made in more recent years. And we can keep adding to that list. That's why all the citations are with examples. But as we already heard this morning, right, there are macro and micro level estimates of profit shifting. There's within the macro level estimates, you know, the Torsolov, Fear, and Zugman is probably the latest one that sort of people have it on their minds. But the country by country data that we're talking about at this conference has rendered various firm and country level estimates of the magnitude of the issue. There's stuff in tax returns data. There's BA data that I hastily added this morning because Kim is sitting there and obviously she's done tons of work in this space. And previous literature has done a lot of work using financial data here, following the Heinz and Rice approach that Florian has talked about this morning. Okay, so where am I going with this? So these data sets, in a sense, are still biased by firm reporting choices, right? The first one is sort of where do I locate profits? The second one, perhaps, we've already been talking about it. Where do I locate my turnover? Sort of where do I report things? That's one. Second one, we all know that all those approaches to estimate profit shifting really require some sort of assumptions about underlying activities. And these differ across studies, and this is why we sort of are having so many different estimates of profit shifting. So I'm heading to the paper that I have, and the paper asks the question, can we measure firm activity independently of how firms choose to report their activities themselves? Okay, so the paper is called Measuring Firm Activity from Outer Space. And I promise the three papers I'm talking about are like cool. Okay, so I'm trying for like cool stuff here. So the first one is, it proposes a new proxy on firm activities that can be obtained globally and uniformly for a large set of industrial firms. And the industrial firms is key here, because what we do in this paper, we need firms to have real operations on the ground. But once they do, we can actually use the area that their subsidiaries, their factories in this case, occupy, and then Nightlight these emit to have some sort of idea about the activity that's happening on the ground. Industrial firms, not Google. That won't work for Google. But what we do is with the data we collect for car manufacturers, in our case, we can actually test the predictive power of these proxies that are basically just like how much land do firms occupy and how much nightlight that land that they occupy produces. And we can do a lot of cool things, right? We can test the predictive power of them. And then we can try to use them to apply to think about the scale of misallocated activities relative to what is reported. Because we kind of know that nightlight, the more you produce, the more nightlight gets emitted. And the paper does tons of things that I'm not going to talk about in detail. I just want to flag like the interesting things for the conversation that we're having today and tomorrow about profit shifting. So as I said, the economic application that I'm going to walk you through is basically the extent of misallocation and unreported turnover profits and assets. And we can talk about sort of whether there can be more that can be done here. Okay, so for those of you who have like no idea, never worked with these sort of data, it's pretty easy to illustrate what we have in mind. Okay, so we have firms, this case VW. VW has tons of factories around the world. They're very proudly, everywhere on their websites announce exactly where they are located. It's pretty easy to Google. Okay, so this is an example. My colleague pulled this up because he knows that factory is right next to his house. Okay, you have the Google image of the factory on the left. In the middle is how land consumption gets operated, right? So you tag the borderline of the factory. On the right is the amount of light that factory emits. Okay, you can do it across the world. So we take the 20 car manufacturers that you have listed here. We had some issues with the Chinese car manufacturers, so they're not necessarily here. We tried. They're being blocked from some Chinese websites, we gave up. And then, so that's why Tesla is here, because it's sexy. And also it doesn't report any unconsolidated information at all. So this was interesting for us as well. But you can see the distribution of factories around the world looks like you would expect, right? Tons of stuff in Northern America and Europe, nothing particularly surprising. So the first question is sort of, are we nuts, right? Are we sort of overkilling this? Can you really use nightlight data to measure any firm activity? Before I'm going to talk about the scale of misallocated activity. The approach is as simple as you could think about. Basically, is nightlight correlated with firm level output measures. Output in this case is turnover, assets, and employment. Okay, so to operationalize this, we do need some unconsolidated firm level information. That's why we picked those. Happy to hear feedback on this as well. There are two facts that I want to talk about. One is the cross section, and second is the panel. So nightlight actually explains differences in terms of economic activity between firms really well. So nightlight explains about 80% of variation in firm activities across different firms. 1% extra nightlight is basically 0.8% of extra activity. That's actually pretty good proxy. It does slightly worse across time, perhaps because our panel is pretty short. It's only 7 years. We bound on two ends by two events. The first one is the dawn of high quality nightlight data in 2012. So we wouldn't be able to do this before 2012 because the resolution of nightlight data was like 1 kilometer by 1 kilometer. 2020, we all know, so I don't need to talk about that. Okay. When we think about our proxy at the firm level, is that the panel setup allows us to compare our estimates to prior literature that uses nightlight data to look at GDP. So we're not super new in reinventing the wheel in that we can use nightlight data to proxy for economic activity. The literature talks at large about using it as a proxy for GDP. We're just saying, could we use it for firm level activity? And it turns out that the coefficients we get at the firm level in terms of their magnitudes are almost similar, almost the same, 0.28 versus 0.287 relative to the literature on GDP. Okay, so it turns out that we can use nightlight data to measure firm activity. It explains cross firm differences really well, and it correlates pretty well to how the GDP explains, how nightlight explains GDP. Okay, so now we're sort of toolkitted with this. What can we do with this, and why is this so cool? Or at least why do I find it so cool? Okay, so if we can use this data, then can we use it to help us understand public reporting patterns of firms in our sample? So specifically, we asked tons of questions. I want to highlight 3. So the first one is how much economic activity is not reported in accounting data. So previously we sort of hand wave and say, well, it's firm size, right? Smaller firms just don't report anything. Well, now we have an independent measure of firm size. We can say that smaller firms or not. Second, how large are distortions in economic activity reported in accounting data? Can we talk about sort of the scale of misallocated turnover or assets? And then 3, are missings and biases in accounting data correlated with any observables? And by biases, I mean how much we're going to predict there's economic activity based on nightlight versus how much actual economic activity is reported. Okay, so there's a lot of numbers here. I by no means expect you to understand every single one of them. I want to highlight 2. Okay, so what is going on here? What are we trying to do? We have those 20 car manufacturers. Each one reports business segment consolidated turnover that's related to manufacturing activities. So Mercedes would tell me that in 2019, they made, $20 billion in turnover from their manufacturing activities, right? We're not taking into account their financial activities. So you can add them all up, and then you know the consolidated turnover of each car manufacturer. Then you can say, okay, I also know the total nightlight emitted by all the factories that they claim that they produce cars in. Ergo, I have that, and I have the total turnover. I can take the total consolidated turnover and apportion it to each factory according to how much nightlight each factory emits. Okay? And then I have an independent measure of how much activity is taking place in that factory, what we call predicted turnover or assets. Or profits. You can do it with all 3 metrics. Okay, so that's what the predicted means here. Reported means like what gets reported in unconsolidated data. The 2 numbers I want you to pay attention to is the 44 and 45%. And we can talk in detail later how we got to these numbers. 44% is basically the difference added up across all the factories that we have between what we predicted and what they reported. It turns out to be 1.29, I think it's trillions here, which is basically 44% of the total consolidated activity is not reported where the actual activity actually occurs. That's kind of large. I'm not calling these profit shifting estimates by any means. I'm just saying the activity estimates reported relative to what we think should be happening there, given that these factories are really sort of emitting a lot of light and are saying that they're producing a lot of things. Okay, the second number is the 45% of turnover. We don't actually know where the activity occurs when we compare the financial data. Okay, so the 2 interesting observations that come from it is that 1, the scale of missing turnover is by no means correlated to the size of firm operations. So that's the first row. We use nightlight as a proxy for independent proxy for sort of firm size, firm operations, and we find no correlation between missing turnover and size of firm operations. Instead, the bog standard, like, is it higher tax countries, we have more missings? Yes. Is it in home countries, we're more likely to get some missing information. Part of it is driven by the US firms. I don't want to point at Americans sitting in a room, but a lot of it is US companies reporting non-consolidated information at home. What about the bias? So the difference between what we predicted and what actually gets reported, you'll see that observations start dropping as we move towards comparing unconsolidated financial accounts to what we can observe in our data that's Orbis's fault. Again, bias is not really related to firm size, but it's also not really related to taxes or sort of being in a home country of a multinational. And the way we read these results together with the missing ones is that to us, it appears like firms may choose strategically to not report financial information rather than report amounts that are not actually quite correct relative to their operations. Now, this is my reading of this finding. Of course, happy to hear thoughts on it. Okay, so perfect. So the key takeaway and why did I talk about this paper at all? The light emitted by factories can be used to proxy for production activity, which I think is pretty cool because it offers us something that's very independent of the choices that firms make as they report, which is the conversation we keep having right now, and it offers us some opportunity to tackle issues related to profit misreporting or profit shifting of multinationals to improve our understanding of what's happening globally. And I think that ties really nicely with the country by country reporting data. Because if I was working on that CbCR data, now I would take the results that we have and perhaps compare it to what firms actually do in country by country reporting or what they report there. And perhaps that's the next step for this project. So why do we need to get this right? So why are we obsessing so much about getting like the magnitude of profit shifting correct? You know, this paper this morning, there's tons of literature on this. Why are we so obsessed? It turns out that profit shifting affects a lot of other things, not just, you know, how much profit is shifted, but it also affects the measurement of GDP and productivity and financial flows. There are 2 recent papers that look exactly at that. So that's why it will be good to get it right. We still don't have it right, you know. And notwithstanding all of this, even if it didn't affect measures of GDP, I think, you know, if we think about sort of where firm activities are located, we want to tax firms where they make profits and not where they reallocate them to. And it will be good to know sort of where are the actual operations to do that. And that last sentence offers a beautiful segue to what I want to talk about next, which is basically, okay, so firms make profits in one place, they reallocate them to another place. What enables them to do this? Another slide that's attempting to summarize the literature, probably doing a horrible job. So if you have a paper in this space, just hand up and tell me to add this to this slide. But here's my thoughts. The literature largely focuses on headquarter level characteristics, right? So we talk about size already. Florian talked about that this morning, but also, you know, things like presence of tax havens, R&D, intensity, intangibles. Like there's a lot of things that drive profit shifting across firms and countries. What matters locally is the question I'm interested in. And if you've heard this paper, I'm so sorry. I think I presented it so many times, but I want to mention it in case you're not aware, because it's one of my favorite papers and don't tell my co-authors. No one heard this on camera. So I'm sorry to my co-authors in the room. So what matters locally? I think it's an interesting question, and I will tell you in a second why, but there's one. So I'm going to talk about organizational capacity and sort of how well managed multinationals are. But there's another paper that touches on this as well that talks about the role of local tax advisors. And again, if there's something else that I missed, tell me or forever stay silent. Okay, so the paper I want to touch on, and I promise you all 3 that I'm talking about are actually related to the broader point I'm going to make, which is how much do we know about firm activities? So first one, we learned not so much. Second one, I'm hoping sort of I'm able to say that we kind of know a little bit more about. And so the question that we ask in this paper is, how does organizational capacity at the subsidiary level relate to profit reporting of multinationals across the jurisdictions? So we're not interested in multinational level characteristics. We're just asking sort of, okay, so multinationals shift profits. Which subsidiaries are they more likely to use to do this, besides the tax haven ones? Okay, they got to shift from high tax countries towards tax havens. Which ones do they use more? I'll tell you in a second why organizational capacity, but let me say the following. There's substantial evidence that organizational capacity, by which we mean better management and managers, to both structure practices on the ground as well as people who implement these practices. Why do they matter? Well, they have positive effect on productivity, so they make firms actually better. But the question is, what about profitability? And do these go in tandem? And since profitability, as I already said, includes tons of implicit allocation decisions, that's important. So why organizational capacity? What kind of ideas do we have in mind? Well, as I said, whether subsidiaries can operationalize whatever the dream the headquarter has about profit shifting, okay, if the US multinational decides they want to be aggressive and move profits around, whether they can actually do this is going to be dependent on whether the subsidiaries that they have can actually make these things happen for them. And then that is going to affect the local effect. That's going to affect the local effect. That's going to affect how profit shifting sort of gets operationalized locally. And that has real local implications, right? If my subsidiaries can't do the things I'm asking them to do, perhaps profit shifting doesn't have as much of an effect locally. If subsidiaries, actually can operationalize, perhaps profit shifting is actually a pretty big deal in those countries. And sort of the second point that I'm going to talk less about today, because I'm not going to show you any results on this due to lack of time, is how we design reforms to tax companies effectively is going to be depending on the type of firms we have in the economy. So if all my firms are like really well organized and can really execute the strategies directed by the headquarter, that's perhaps a good thing, but that when you design tax reforms, it turns out those companies are actually much more responsive to changes in tax system. And so you might have to take that into account for your policy. As I said, I'm not going to show you anything. If you're interested, obviously the paper and the whole 80 pages that it has by now. Okay, Orbis data, we all know it. I'm not going to talk about it. I want to tell you a little bit about how we operationalize the notion of organizational capacity. So we use a well-established measure from the organizational economics, which is World Management Survey. What the WMS data does is it takes a random sample of mid-sized manufacturing firms from a country that it's surveying, let's say Czech Republic for a good example, and the distribution of firms is between 50 and 5,000. Okay, so we're not taking the largest manufacturers, we're not taking a Ford plant, okay, but we're also not taking a mom and pop shops. This is just mid-sized manufacturing firms. We use multinationals only for the purpose of our study, but the idea behind the survey is that they call people up and they run like a semi-structured interview with plant managers. They don't ask plant managers anything about themselves, so not about their education or their management style. They just want to get idea about how the structure of management looks. I'll give you some examples of questions in a second. They're open-ended questions, and responses are scored by 2 or 3 researchers on a scale of 1 to 5. So there's someone listening into the call as well. And they're given a score. Sort of 1 is, there's no formal management practices on the ground. Like no one knows what's going on, basically. And 5, it's like best practices. So like everything is monitored, everything has a clear goal and a clear reason behind it. Like that's kind of the scale. Because of course, the difference between like 1.9 and 2.1 is kind of hard to pinpoint. A lot of literature in that space uses the dichotomous measure of sort of informal with a cutoff of 3 being formal management practices, and we use that language throughout the paper and the presentation. So what we're going to use is the average of operations management scores, and those are things like performance tracking and review, process documentation, and target setting. So we're talking about like really simple practices where firms actually just monitoring what's happening. Okay? Because they're so simple, none of it is rocket science, but it turns out that firms that actually implement more of these practices, they have higher productivity, growth, R&D expenditures, and lower exit rates. So these things are good for firms, right? And in the paper, we're asking, okay, are they also helping them really move profits around? Like this is as simple as that. It's going to be very distinctive from good managers. Okay, so the managers will be implementing these practices for sure on the ground, and there's going to be a headquarter manager who's going to make decisions about profit shifting. But what we propose in the paper, and this is an abridged version of conceptual framework, that even the best managers need these management structures to actually operationalize their strategies. And so if you're still confused, here's the idea. I would call you up on a phone and say like, hey, so what kind of key performance indicators do you use for performance tracking? How frequently do you measure this performance indicator? Who gets to see this data? Like, do you put it up on the board or is it like in your ledger? Is it online? Do you know like sort of where you're heading with this? If I was to walk through your factory, could I tell how are you doing against all those KPIs that you have? And here's, an example of performance tracking question where a score of 1 means like no one is tracking anything. So people just have no idea what's going on. They're like making those widgets, but they're just making, right? And 5, it's like, okay, the manager said we need to make 5,000. We're like 4,500 in. Like we know where we sit. We know where we're going to get to like those widgets. Why am I stressing this so much? Oh, here's the ledger example on the left and sort of the board example on the right. The ledger is probably something like 2 or 3, depending on other questions. The board is probably closer to 4, right? People know what's going on. What is key for us in this context is that this is independent of any financial reporting. Like those managers aren't asked any questions about financial, right? They're just like, hey, so, how well are you keeping track of things that are going on? This is, in case you're wondering, this is where the survey was run. So this is the list of countries where they picked a random sample of firms and ran this survey. So we have a large distribution of countries when it comes to tax rates. Sort of Ireland is here. US is also here, but we have no unconsolidated firm level stuff, so we can't do anything with the US in spite of our best attempts. But you have a bunch of other sort of quote unquote high tax countries. And you can also see that the distribution, the wedges give you distribution of management scores is pretty wide. Even in Germany, that you would maybe think it's like, a well-organized country, there's still some firms that do really badly. Okay, so to me, the most interesting part of this paper is the conceptual framework, because the results are going to be pretty straightforward once I explain to you what we have in mind. So why am I sort of obsessing about this plant level, subsidiary level management and sort of helping firms operationalize these strategies? So we're thinking about those mid-sized manufacturing plants that belong to large M&Es, because we're talking about the surveys done at manufacturing plants. Most of our subsidiaries are manufacturing subsidiaries. That's not particularly shocking given the selection that's done. How do we think about sort of chain of order of decisions here? Okay, so headquarter decision. Managers at the headquarter just choose whether they want to shift profits or not. This isn't a decision of a plant manager, right? The guy who's making the widgets and deciding like, where am I in my plan? It's not really thinking about shifting profits. Production is located in high and low tax countries. Profits don't need to be co-located with this. Again, not a shocker to this audience. Perhaps in a frictionless world, everything would be in tax havens, but it isn't. Okay, so here's a contentious slide, especially in Europe, because I made some cultural assumptions. Last time I presented this, people went throat to throat. So here's an example. Let's say that there's a US multinational that operates in 3 countries outside of US, Ireland, Germany, and France. Let's say that both Germany and France are high tax countries. German firms are well managed. French ones are badly. I didn't say bad, I should say badly worse managed. Okay, just for sake of example, and Ireland is a low tax country. Okay, so now we're going to take this structure as given, and let's think about headquarters wanting to minimize tax liabilities. What is it going to do? How are we thinking about this? So we're thinking, well, each subsidiary is going to use provisions in local tax code, right? They're going to try to use all the depreciation, R&D, and patent boxes and whatnot exist there to minimize the tax. But then they might want to locate profits in low tax jurisdictions. Now, in this example, Ireland is in our sample. That's a low tax country. You can call it a tax haven if you wish. For our purposes, it's just low tax country. What is the multinational going to do? It's going to try to move as much profits from high to low tax countries. Again, not shocking. What do we propose? We propose that it might use the German subsidiary more than the French one. Why? Okay. Well, 2 reasons. First, maybe the German ones are better organized. I did not say that. And so they're better able to take advantage of local tax code. But there's this aspect of organizational capacity, which is linked to uncertainty. So if my plant can tell me exactly how many widgets they're going to make today, tomorrow, and in 5 years, then everything is more predictable. So I can try to shift as much as I can without running into losses. Okay? And this is the idea behind the paper. In terms of conceptual framework, there's equations attached to it as well. But basically, better managed subsidiaries perhaps may have lower overall cost of shifting profits from high to low tax location. Now, this idea of organizational capacity is not going to affect whether you're going to shift any profits at all. It's just going to affect the extent to which multinationals can engage in these practices and sort of which subsidiaries they're going to engage in these practices. And if we think that our notion of predictability is substantial, then we also think that these results should be driven by aggressive tax avoiders. And as I said, once I have it, then what I'm going to show you is not going to come as massively shocking. So this paper actually stemmed from just this simple graph. My co-author and I made this way back in 2019, and we're like, hey, what gives here? Okay, so better managed firms in low tax countries have higher profitability on the left in the red, but they don't in high tax countries. And this graph looks the same for productivity. This has sort of been highlighted by the organizational economics literature. So we're like, hey, what gives on the right? And, you know, if you like the tails, you can even say, actually, the really, really well-managed ones are less profitable. So what's going on here? You know, you can tell me maybe this is just across firms, not within a multinational, so maybe firms are just different. Well, the same pattern occurs within a multinational as well. It turns out that multinationals report lower profits in their high tax subsidiaries relative to their own low tax subsidiary locations. We kind of are running out of sample here, but these differences are significant past the score of 3, which is why the formality tends to be important. Okay, so I just told you that better managed firms report lower profits. There might be tons of things, right? Could it be profit shifting? Well, key challenges we know is that we don't really observe profit shifting. So we're going to use tons of proxies and try to battle this data with different proxies. I'm not going to show you all of them. I'm just going to flag the few important ones visually. Okay. So using those aggressiveness proxies, we're going to try to think about whether this pattern can be explained by this. If it's not profit shifting, the aggressive and non-aggressive multinationals should look the same. Okay. Tons of different proxies. We use the propensity to report profits near zero. We use presence of tax havens. We use book tax differences. We use share of financial subsidiaries. We tried tons more. This is a key figure. On the left-hand side, you can see firms that are aggressive, multinationals that are aggressive. On the right, you see non-aggressive ones. Again, it's plotting just the relationship between profitability and management for high and low tax countries. And that pattern, the better managed subsidiaries report lower profits in high tax countries, is only there for aggressive firms. For non-aggressive firms, the better managed you are, the more profitable you are, just like the more productive you are. Okay, so then, you know, you can like slice and dice it in different ways. I like these because they're visually easy and there's 0 assumptions that go here. This is just a distribution of profitability for firms that are better managed, formally managed, and informally managed, and high and low tax countries. High tax countries, blue line, low tax countries, red line. Okay, you see large bunching around 0 for formally managed firms in high tax countries. Only when they're aggressive, not when they're not aggressive. And again, I'm using different sort of measures of aggressiveness here to showcase that it really doesn't matter. Okay, aggressive firms, huge bunching for formally managed firms, non-aggressive, nothing going on here. Okay, so we think that we find that subsidiaries that belong to multinationals that exhibit these sort of hallmarks of aggressive behavior drive the relationship between management and profitability reporting in low versus high tax countries. So we think this is consistent with the fact that better organizational capacity is helping firms move profits around. Could it be something else? Of course, right? We test tons of things in a paper, including managers, where there's actually a large literature on this. We don't find any of this really matters above and beyond the organizational capacity. So our measures of organizational capacity stay significant whatever we throw at this data. Of course, we can throw more always. Again, the paper does tons more things. I just wanted to highlight sort of the main and interesting results. And so the key takeaway is that, you know, this is more than just managers cooking the books. They need structures to be able to cook those books. And because management data is so awesome, we actually get like individual practices related to monitoring and target setting. And we can actually test which ones are correlated most with our mechanism. And it turns out it's all related to monitoring, which kind of corroborates the idea of the predictability argument, which is amazing for us, but I didn't show you this, so you just got to trust me. Okay, so why do we need to get this right? As I said, the extent of real economic impact of profit shifting is going to depend on the capacity of subsidiaries to operationalize these strategies that are directed by headquarters. And this is something that I want to say but it's controversial. Well, high tax countries are likely to get lower tax revenues from those good firms. We want those good firms in the economy, right? So, you know, as governments think about cutting tax rates in the short run, especially, it's actually the effect of that is going to depend on the composition of firms in the economy. And I'm doing really well against time because I timed myself and I have 15 minutes. So I want to say something about the role of tax havens in facilitating all of this. And I promise this is just a flash with like a couple of figures and a couple of interesting facts. So we know that a growing number of firms globally uses tax havens. I like these maps. I have never gotten to use them in the paper. So here's me using them in presentation slides just because I can. So what this does is it aggregates the number of tax haven subsidiaries by parent country. So for the US, it will take all the US multinationals that are in Orbis data and add up all the subsidiaries that they own in tax havens in 2005. Okay. And because we have historical ownership, we can do it year by year. Well, it turns out that the picture obviously changed dramatically by 2016. I think this is where we cut the data last time I looked into this data. This is an abandoned project for now. But you can see this is just was the change that increasingly, so firms are using tax havens. This isn't shocking to us, but what I want to talk about is sort of what happens in these tax havens. So in this particular paper that's coming out as a policy paper, actually, so it's just a descriptive paper, we investigate the use of IPs in multinational tax avoidance strategies. So we ask a very particular question. Can we see whether multinationals locate patents in tax havens, and sort of can we say what is the scale of this, especially in relation to the global minimum tax proposals? And so we have, I think, a couple of interesting facts that I didn't think about when I started working on this. On global patenting activities, then importance of what we call tax havens, and then we can grapple with definitions of this as well, and the differences across tax havens in their role for IP-based profit shifting. What we use, and I don't know how many of you have used this, but this is Orbis IP database. So this is a combination of European Patent Office data and US IP data and all the other patenting offices in the world. So basically you have the global, hopefully almost universal coverage of all the patent applications globally. And because it's Orbis, it's kind of neat because you can match it with some financial and some ownership information of a subject to all the issues we have with Orbis. Okay, so what can we, like, what would I expect in terms of patent location and what can I observe? Well, suppose the innovation happened in tax haven, the patent ownership should be in tax haven. Actually, I can actually see a patent application being filed in a tax haven or by a subsidiary that's located in a tax haven. I'll tell you a little bit about the data. Okay, what if innovation happened in any country, but patent ownership, this is what jet lag does to you, words don't make sense, of patent ownership ends up being in a tax haven. Well, the data is cool because you can see transactions. Okay, so you know when the patent sold, who sold it and who bought it, when, and when did it, where did it end up? So was it a tax haven? What we do not observe is cost sharing agreements. So if you're sort of in the weeds of this literature, a lot of times multinationals would just reach a sharing agreement with a tax haven and say, well, you know, we'll pay royalties, patent is not located here, but it's located here for tax purposes. We do not see this. So what I'm going to show you is basically a tip of iceberg, which takes me back to how much do we really know about firm activities, okay? How cool is this data? So it's like 86 million applications for patents by 2 million applicants, okay? So 46% of these applications are in a location different than the actual firm that's applying for a patent is located. And 7% of these patents are transacted at least once in the data set. And you know whether it was an intra-firm transaction or not. So you know whether, you know, it was bought and sold within the same firm. For some patents, we have values, but I'm not going to talk about this so much. But for the purpose of what I'm going to show you, we're going to think about 3 types of location. That's a location of application, applicant, and final buyer, right? Those could all be tax havens. Possibly. The neat thing and the ability to link it to Orbis is that we can try to think about the scale of patenting activity that happens by those firms that perhaps would be subject to the global minimum tax. So if we take sort of the latest set of regulation and say firms over 750 million turnover in euro in 2019 would be subject to GMT. That turns out to be something like 9,000 multinationals globally. We can get their ownership structure, so we don't only know the parent, but we also know their subsidiaries. So you can kind of have an idea of how many patents by those firms that might be subject to Pillar 2 restrictions are sort of done by headquarters versus subsidiaries. And I'm going to show you just stuff focusing on patent applications after 1990. We can go back all the way, but it's less interesting. Okay, so something that I wasn't aware of, maybe you guys are aware of, is sort of the vast majority of patenting activities, of course, happens amongst Pillar 2 firms. Those are the ones in red here. But the share of patenting activity and patent applications by Pillar 2 firms has been declining since the financial crisis. And the larger and larger role in these patent applications is being played by smaller firms that are not going to be subject to any of those global minimum tax restrictions. What is interesting is this looks like a large share, and we're like, yeah, of course, large firms do it. But these firms are only 2.6% of all patent applicants in this data set. And yet on average across these 20 years, 30 years, they actually made about 43% of all the patent applications globally. Most of them were done by headquarters, but a lot of them are done by their subsidiaries as well. Okay, so what about tax havens? I promised something about tax havens, right? I haven't talked about them so much yet. So let's think about sort of what is the share of patents that ends up in tax havens. Okay, so again, I'm splitting them by sort of all firms and Pillar 2 firms. One thing that was striking to me is in spite of all the regulations we're putting on those large multinational firms that are supposedly subject to those Pillar 2 restrictions, you know, the share of patents that are being located in the tax havens has been increasing for them steadily since 1990, and they moved from 2% to 4%. Is it a lot? I don't know. I don't want to take a stance here. Is 4% of all your patents located in tax havens a lot of patents? I have a cool statistic. I thought that at least that was cool. That's coming on the next slide. So suppose I took all the patents that are being applied for by firms in Cayman Islands and just divided them by the population. And I did that for every single of the 240 countries in the world. So just sort of, okay, so Cayman Island subsidiaries apply for that many patents. You know, this is the population of the country. How innovative is this country? And I ranked them. What would we expect to come up on the top? Cayman Islands, just because I use them as an example. Okay, so I didn't fetch this ranking to put tax havens right on top. This is what comes out if you just rank all the countries globally. It turns out that between 1990 and 2019, which is when our data goes, every single resident of Cayman Islands applied for almost 2 patents. I mean, you can argue with me that maybe they're more innovative. I don't know. Like, we can have that quibble. But it's interesting that the 4 countries that come on top are all tax havens, right? And then it's Japan. Okay, so there's a lot of patenting activity. You won't see US here. There's a lot of Americans, I guess. But, you know, this is an interesting ranking in itself. There's a lot telling here. Okay, so perfect. So 1% of all patents turns out to be bought by a tax haven affiliate. And that doesn't sound like a lot of patents. It just turns out that most patents are not transacted at all. If only 7% of patents are transacted, is there something very special about the patents that are being sold, especially towards tax havens? Well, it turns out that obviously if you transact a patent, it is more valuable, either through the Orbis valuation calculation as well as through citations as well. And it turns out that the share of tax haven applicants is triple in a sample of patents that were transacted, right? So there's something special about the transacted patents. So we investigate the use of tax havens for just those patents that were transacted. And here's where the numbers, like, to me, were huge. So I want you to focus on the right-hand side panel and the orange line. So the one right at the top. What it tells you is that in recent years, almost 30% of patents that were sold at least once across border ended up in a tax haven. I thought that was large. That's a third of all the patents that get transacted within Pillar 2 firms, qualification, end up in a tax. Okay. On the left, you have all patent transactions, not just cross-border, and they takes into account things like US to US sales and so on. To me, that's a pretty large number. Okay, as I'm heading to the end, what do we take from this? Is that tax havens play an important location, play an important part in location of IP, especially when it comes to locations of applications and destination for those transactions. What I sort of want to allude to, and perhaps, this is like ambitious to draw from the stuff I just showed you, but it seems like for once the current initiatives aren't actually particularly more costly for those Pillar 2 multinationals in terms of tax haven patent locations, because they still seem to be increasing the share of the patents that are located in the tax havens. In a paper, we do a little bit of work about those size-based thresholds to show that actually the tax haven presence in terms of patents doesn't vary across size thresholds. So we sort of speculate, could there be something else that we could do? And just to link it back to the question that I asked at the beginning, we can't observe everything. So this is just the tip of the iceberg. That's like the observable stuff, right? That's the stuff that firms don't mind you seeing. What else is there that they do mind you seeing? And so I want to conclude, this is my last slide, on a question rather than an answer. And I think, this question lends itself pretty well to the subject of this conversation, and that is how much can we actually know about multinational operations? We're asking them to disclose more and more data, but is there a limit? Maybe not what is the limit, but is there a limit to how much we can learn? So we're asking them to disclose country by country reports because we're asking them for more quantitative information, right? And there's evidence that says that these initiatives reduce tax avoidance, which is great, but they also induce other behavioral responses. So where we're asking them to disclose data, we're also changing their behavior. Like, how much are we learning from this as a sort of push and pull game? And I don't have the answer, I'm just posing a question. I think it's a fascinating question to think about. Sort of, to the organizational capacity. What about some qualitative information, right? How much would we garner if firms told us a lot about what they're doing, their profit shifting strategies? And a lot of countries actually mandate these type of things, UK being one of them, when they ask firms to disclose tax strategy reports. But it turns out that a lot of firms just greenwash what they do, and they just say rosy things. Yes, we comply. Yes, everything is great. But then, there's just a lot of volume and not much information in that. So what are we really learning here? And so I suppose I wasn't going to end on grim thought, but here I am. Is there a limit to what we can learn about profit shifting of multinationals? That if there isn't, let's just try to investigate that more. And with that, thank you so much for your attention.
Thank you.
5 minutes, right?
Yeah, thank you very much. Very cool.
Any questions? I take them gladly over coffee and a snack.
Perhaps we have or don't have time for a few questions, if there are some now.
Or you can catch me.
Please.
Thank you very much. In your first paper, I don't understand. You show that 44% of the turnover is not in line with your data, but your data is about the production.
Mm-hmm.
And the turnover is about sales. So it is not a surprise that the sales are not in line with the production. So I did not understand.
Yeah, so we need some sort of measure of firm size, right? Operation. So we try with turnover, we try with assets. We sort of trying to just proxy for something that proxies for firm operation. I agree with you. Not a perfect proxy by any means. We just try to sort of think about sales would be to customers. This is sort of turnover is the amount of cars produced. That's how we think about turnover. But I think point very taken.
But I think this is a key question because when we want to have the tax which are paid where the activity is,
we need
to precise what is the activity, the production, the sales, I don't know. And this is a main drawback in the actual legislation today.
Yeah.
In practice, it is very difficult to do it.
I agree with you.
Okay.
I agree.
I don't- I don't have this-
I think it would be good to have like different metrics as well that we sort of look at the aggregated multinational level and then try to allocate them to get at your point. I think, you know, if you have suggestions like, I'll take them gladly because I think that's something we struggle with as well. That's like assets, are there, so employment, is there profits as well? Like, yeah, it's the intersection of all of those measures.
I'm really interested, like, so the title is, what do we know? What I'm really interested to know is, and just your own opinion, like, do we know enough to set policy? Because the policy and what we're finding out seem to be, CbCR honestly seems like quite a victory to come out of research that said, hey, there's so much we don't know and we're not going to know it. So we
need to know it.
So now we're kind of at a new point in the journey.
Yeah.
Do we know enough to set policy? Or should we be plotting with it and saying, let's learn it?
So I'm more of a learning person, but that's just my personal thing. I would, I'll be all for just pausing for a second and thinking about sort of if we're going to design international tax policies, perhaps we should think first about what's happening in the data, right? And like, global minimum tax is a perfect example of this, right? Is the rate correct? Sort of what do we learn about behavioral responses of firms as well? I mean, that would be my response, but I'm a data person, so that's what you are going to get.
Do you have a final question?
Then let's continue with the discussion after we take a group photo. So let's now move on to the very old and very important group that is just next door, where everybody who starts studying here has a ceremony there, who's finishing their studies, a ceremony there. When you become a professor, you have another ceremony there. And now you are all invited there just to take a picture. It's, but you've earned it. Thank you.
All right. Well, thanks a lot for being back on time, almost. We have another research session right now with Stefan, Till, and Julia. I hope they're all there. Perfect. So, yeah, Stefan, please, you have 20 minutes.
Yeah. Check it. Yeah, now it is. Yeah, good afternoon. My name is Stefan Peck. I'm a PhD student at the University of Mannheim, and I'm very grateful for this opportunity to present my joint work with Christoph Spengel and Raphael Müller. The paper I'm going to present is titled "How do investors value the publication of tax information? Evidence from the European public country-by-country reporting." So in a nutshell, what is the paper about? We want to examine the question how investors react to the announcement of the European Union to make the currently prevailing confidential CbCR scheme a public CbCR scheme across industries. Why is answering this question relevant? As transparency experts, I think we all agree that tax transparency in general, but particularly so in light of the sustainable finance and sustainability topic, is really gaining momentum, both in academia and in the field for business practitioners. In the past 5 to 6 years, we've seen an accelerating number of newly introduced tax transparency measures and reporting standards. And each of these measures and standards come with their very own characteristics. So we distinguish between qualitative and quantitative, mandatory versus voluntary, but also confidential versus public reporting and transparency. And as the literature identified, each of these characteristics may have their very own implications when it comes to the costs and benefits of the respective measure. Now, the setting that we are looking at is quite unique in a sense, and in the context of country-by-country reporting, that it required firms to publicize or to publicly disclose information that they previously reported confidentially to the tax authorities. And therefore, this allows us to isolate the effect of a publication. So to look at the characteristic of a public disclosure. And this yields some policy implications for endeavors in other parts of the world. We've already discussed today that the Australian government contemplated and now published their endeavors to make their currently confidential CbCR scheme a public one. Another recent development is the endeavor by the FASB in support of SEC, which also want to or intend to publish standards which are essentially public CbCR schemes. How do we approach our research question? We do so with a traditional finance style event study, which is described, for example, by Kutari and Vana and continuously applied in the extant literature. For our cross-sectional analyses, where we want to identify the different channels that might explain the overall investor reaction we are observing, we are conducting sample splits along meaningful indicators, but I will explain that in a minute. You're all experts on CbCR, so I will keep this shortly, but let me briefly explain how the public proposal that is subject to analysis in our study compares to the prevailing confidential scheme by the OECD. When we look at the personal scope, we see a slight limitation on the side of the public scheme. The turnover threshold of 750 million euros, which has to be exceeded once under the OECD scheme, has to be exceeded in 2 consecutive fiscal years. But given the size of the firms, that should not be a material difference. In terms of the geographic scope, we again see a slight limitation on the side of the public scheme. In Florian Neumeyer's presentation, we've seen the tables, and there were separate lines. And according to the OECD scheme, every jurisdiction in which the MNE conducts business operations in has to be disclosed in a separate line. However, this is not the case under the public scheme of the European Union. Here, a separate line is only required for EU countries or EU tax jurisdictions and any blacklisted non-EU tax haven jurisdiction. All other jurisdictions can be aggregated into a separate other line, and therefore the picture that is granted or provided by these public reports is less comprehensive as compared to the confidential one. And finally, in terms of the key financial indicators that are required, we also see some limitations on the end of the public scheme.
So the split of revenues between related and unrelated party revenues is not required. Stated capitals do not need to be disclosed, and the tangible assets do not have to be disclosed either. So having looked at this slide, I hope that you agree with me on 2 points. The first one is it is essentially the same set of firms that is affected by the public CbCR scheme that previously reported under the confidential scheme. And this allows us to isolate or to exclude potential additional compliance burden to be a driver of a potentially negative effect, because the endeavors are already made to collect all the data and to report it to the tax authorities. And the second point is, given that the information was already available to the tax authorities, even in a more comprehensive way, also allows us to essentially exclude that better informed tax authorities, respectively, better targeted tax audits, for example, might drive a negative investor reaction. So what we are left with are the effects of a mere publication, and the widely discussed channels of a publication are the reputational concerns on the one hand side. So firms being in fear of being publicly exposed as an aggressive tax avoider, and secondly, proprietary concerns. So firms fearing that proprietary information, which is helpful to their competitors, might be disclosed and might lead to competitive disadvantages vis-a-vis non-disclosing firms. So that's about the institutions. Let me briefly explain the timeline that we were facing when we tried to identify the relevant event for our event study. The discussions about the introduction of a public CbCR scheme in the European Union are essentially as old as the confidential OECD scheme, so dating back to 2016. The most recent attempt was made by the Finnish Council Presidency, or under the Finnish Council Presidency, which, however, failed by the end of 2019 to secure a majority vote in favor of a public CbCR introduction. Under the following 2 presidencies, the topic was not put on the political agenda at all. And it was only revived by the Portuguese Council Presidency, which in the beginning of 2021 published a new compromise draft, which was supposed to bring the different member states back at the table again. Following this vein, the member states and the representatives of the member states were then invited to an informal exchange of views on this new compromise draft on February 25th. Now, here it's important to mention that this was really an informal meeting, so it took place in the form of a video conference, which is actually not in line with the protocol of the European Union. Everything was quite uncertain at this stage still. There was not an actual discussion going on, but the member states representatives were reading out 1 to 2 minute prepared statements, which explained the stance on this view. There was no formal vote or anything, but nevertheless, this exchange of views set the ground for the legislative bodies of the European Union to enter into the formal negotiations, the so-called trilogue negotiations. And these trilogue negotiations then took off at the end of March 2021. Here it's important to say that these trilogue negotiations typically take an extensive amount of time. So typically it lasts for several months. And still at this stage, there is a level of uncertainty, because if the institutions fail to strike a compromise and to reach an agreement, then everything would be off the table again, and one would have to start at zero, essentially. And therefore, it was quite a surprise that only after the 3rd meeting of this trilogue negotiations, the EU Parliament made an official announcement that the trilogue negotiations have led to a provisional political agreement on the introduction of a public CbCR scheme. And therefore, this point in time really marks for us the point where a rational investor would have updated his or her beliefs about the likelihood of a public CbCR introduction in the European Union. And I think this quote by KPMG here summarizes the surprising character quite nicely. As they say, they thought it wouldn't happen until it did. To confirm our assumption about this main event date, we are conducting a media coverage analysis using the Factiva database. What you can see on this graph here is the absolute number of search term results, search results for the search term country by country reporting. And as we would expect, there is a significant spike around the announcement of the EU Parliament, June 1st, June 2nd, which confirms our assumption this should be our main event. Interestingly, we also find a remarkable yet significantly smaller spike around the February event, so the informal exchange of views. However, given that everything was still very preliminary at this stage and unsure, and after manually inspecting the media articles that were published around this event, we still do not assume that a significant investor reaction is visible already at this stage. But nevertheless, we pick it up as an alternative event date just to make sure we are not missing out on any potential reactions. Okay, our empirical approach, as I said, it's a typical finance style event study. So we are implicitly assuming that the capital asset pricing model is the return generating process underlying the observed stock returns. So we are regressing the actually observed returns on the capital asset pricing model. So here we have the Janssen alpha, we have the capital market beta. For the market portfolio, we are proxying with the MSCI World, given the multinational scope of our sample and the size of the firms. And everything during the event period, which cannot be explained by the capital asset pricing model, will then be captured by this coefficient gamma here, which is the coefficient of a dummy variable, which turns 1 for trading days that fall into our event period. We are choosing a 2-day and an alternative 3-day event window based on our Factiva analysis. And following prior literature, we use a 1-year estimation period, which ends 6 days before the event for the estimation of the coefficients. And to account for autocorrelations, we are clustering our settlement errors on firm level and on trading day level. For our cross-sectional analyses, we are augmenting the model by an additional indicator variable, which helps us to distinguish firms with different reputational concerns and different proprietary concerns. And the coefficient of interest then would be the coefficient gamma here, which is the coefficient of the interaction term of the indicator and our event term. Okay, next step. What are our results for the main event? As you can see here, our preferred specification, the shorter 2-day event window, yields a significant negative investor reaction of 0.484%. If we add an additional day to our event window and make it a 3-day event window, the coefficient increases in size and becomes even more negative, 0.66%. Now, these coefficients sound quite small, but what we need to keep in mind here is that we are looking at the almost 700 biggest firms in the European Union, which also translates to their market capitalization. And when we translate these figures into monetary terms, we find a cumulative value loss, stock value loss, between 48 and 65 billion euros. And to put that number, these numbers into perspective, this corresponds to the about 15% of the corporate income tax revenues that are collected in the European Union in 2021. So quite high numbers, actually. For the alternative event in February, we do not find significant results. The coefficients here are positive and comparable in terms of magnitude to the coefficients that we find for the main event. However, as we expected, given the preliminary stage, the reaction is not significant at statistically conventional levels, which is in line with our assumption. So after identifying an overall negative investor reaction, we now want to turn to the different channels. So the reputation channel, the proprietary cost channel, and try to identify which of these channels might explain this overall reaction. I tried to summarize all of our cross-section results on a single slide. So let me briefly go into more detail what you're actually seeing here. On the left side, you can see the indicator variables that we use to distinguish firms with higher versus lower reputational concerns. So here we argue that firms with lower ETRs, with higher intangible to total asset ratios or intangible asset intensity, might be more prone to being exposed as an aggressive tax avoider because they are either displaying higher levels of tax aggressiveness or because they have a higher profit shifting potential. Firms operating in the B2C sector are more visible and salient to the consumers and therefore also more prone to public scrutiny. And we argue that firms with a low ESG score, so with low ESG performance, in particular in the governmental pillar, are also more prone to reputational concerns. And in fact, for all of these variables, we find significant results. So we find a more pronounced negative investor reaction for firms with low ETRs, high intangible asset intensity, B2C sector firms, and firms with low ESG performance. On the right-hand side, you can see the indicator variables we use to distinguish the different levels of competition. So the fierceness of competition that our sample firms find themselves in. Here we are looking at the industry concentration in terms of revenue using the established concentration measure, the Herfindahl-Hirschman index. We are also employing two dynamic measures since this is only the static state of competition. And we look at the competitor growth rate and the turnover growth rate of the industries over a 10-year period. And we also look at the profitability of firms, as we argue that firms which are able to sustain high profitability over a longer period of time, in this case, five-year period, are likely to have a competitive advantage over their competitors. And therefore, the information might be more sensitive to them vis-a-vis non-disclosing industry competitors. The evidence here is less conclusive. The industry concentration does not seem to play a major role from an investor perspective, nor does the turnover growth, but we do find a more pronounced investor reaction for firms operating in industries with a higher competitor growth rate and for firms that are on a five-year period more profitable. Finally, we then want to assess the relative importance of these two cost channels and therefore use an integrated regression analysis. So we are using all of our indicator variables that you've seen on the previous slide and run some sort of a horse race. And what's interesting here is that what's left significant and negative is essentially all four indicator variables for the reputation channel. However, none of the proprietary cost channel variables is significant anymore. And from that, we conclude that the reputational channel seems to be dominant over the proprietary cost channel. Okay, coming to the end of my presentation, let me briefly conclude. What do we learn from the paper? We learned that investors expect the cost of public disclosure to overweigh the potential benefits from an extended information environment. The corresponding stock market response leads to an aggregated loss in firm value between 48 and 65 billion euros. And this negative investor reaction can be explained both by reputational concerns and by proprietary concerns, whereby the reputational concerns seem to be the more dominating channel. And from that, we conclude or argue that legislators and standard setters should carefully consider the merits of a public disclosure mandate or regime. That's about my presentation. I'm looking forward to any comments from your side.
Thank you, Stefan, also for being on time. Very well. Any questions in the audience? Yeah, yeah.
It would be great to have a cross-sectional hypothesis. For example, if you took financial services firms or firms that are unaffected in those states, just to make sure that you know this effect if you're documenting single stage regression, right? In the old days, some of the studies that you cite, you've done the CABM estimation in the pre-period and then by the CABM coefficient estimates for your period of these proposed changes.
Yeah.
I think you're doing what's state of the art, so it's not a criticism, but more a suggestion. For example, financial institutions in the EU should be less affected because they already disclose something that's close, as you know, not the same.
Yeah.
And then if you find that in the cross-section, that further corroborate this.
Yeah, thank you very much. That's a great comment. We actually do a difference in difference analysis also with control firms where we look at these excluded industries and use them as a control group. But we do not go into the cross sections there. So that might be something that we want to have a deeper look in there. But thanks for the comment. Yeah.
I saw one more back there. If not, then comes also.
Yes, a similar suggestion for the identification is very important. So maybe a firm from other countries in your definitive, or maybe firm with no foreign turnover, but you need, I agree, you need to be to go deeper to the identification study.
Yeah, okay. Yeah. So the difference analysis would help you in these concerns, or
I think so, yes.
yeah. Okay.
The control group,
Yes.
financial services, firm from another country,
Yeah.
Switzerland, I don't know.
Yeah. Unaffected.
Yes.
Yeah.
Or a firm with no foreign activity.
Yeah, so we've done that, and the results remain robust. And also with regard, I think you mentioned that you would estimate the coefficients in the estimation period. It's effectively more or less the same. We've also done a portfolio regression, for example, and the results are exactly the same. But yeah, thanks for the point. So we will make that perhaps more clearer in the future.
All right, any other questions? Yeah.
These are very short-term effects. Do you know anything about the longer term? Does it stay low for these firms?
Yeah, that's also a good point. Of course, the magic, so to speak, of the strength of this approach is that it captures short-term effects. It is almost impossible, I would say, to estimate the long-term effects. There are studies which are using longer event periods, but then, of course, you have a lot of confounding events. So I would agree. I would love to pin down on how lasting this effect actually is. But so far, I haven't stumbled across a convincing identification approach that would help us in figuring that out. But we'll take it now.
Right. Yeah.
Could you say a few more words on the policy implication? Because well-functioning capital markets shouldn't the extra information, in fact, press on stocks, and that's a good thing because then the allocation of capital goes towards companies with less, negative reputations, which is exactly what you would want. Like, so you seem to apply at the very end, and my apologies because I haven't read the details of the paper and maybe it's in there, but the results gave you pause. But you could also, another view of it is that maybe that's what should happen.
Yeah, I absolutely agree with you that this would be the desired effect if we would be 100% sure that those firms with what we call a higher reputation concerns are actually also the more tax aggressive firms. One example would be, for example, the ETR. There are, of course, many reasons, also legitimate reasons why one would have a low ETR instead of being, besides to being an aggressive tax avoider. So yeah, we've made a slide comment or a slide section where we discuss the economic meaning and significance of economic interpretation. But it's at this stage very difficult to really isolate which part is really directed at those firms which are just in a justified way suffering from these reputational concerns and which are unjustified. So yeah, if you have perhaps a better approach to that, we could discuss that in the next coffee break. But yeah, so far this.
Because it sort of relates to the last question, right? Because it would be more a long run capital allocation.
Yes.
One step, but short run event study.
Cool. Thank you very much for just.
Thank you very much.
Our next presentation is by Phil. Let me just find your slides. There we go. Recent version because it's just ever.
Great. So first of all, thank you very much for having accepted me to this great conference. It's a great pleasure to be here today. What I want to talk about with you for the next 20 minutes is a current working paper of mine that I'm working on together with my doctoral supervisor, Christoph Adrien, where we examine the consequences of tax transparency, particularly country-by-country reporting, of course, US country-by-country reporting, to mention this, on the quality of internal controls by firms. I'll come back to this in a minute, because I think this is a concept that the accounting people in this room are probably familiar with, but the economics people perhaps not. So I'll come back to this in a minute. Starting with theory, as I mentioned, more of an accounting perspective. So what I focus on here in the first paragraph is the accounting perspective on the research on CbCR. I'm of course not the first one to research from this perspective. There are some great papers all showing some form of real effects by country reporting on tax avoidance, for instance, on economic substance, or how economic substance changes to align better with reporting. Also, voluntary disclosures. There is another paper on US country-by-country reporting that's going to be presented tomorrow. These are very important findings that we have in the literature already, but what has not yet been examined in further detail is what happens within the firm, what internal responses CbCR creates within a firm. And that is an important point, because the collection of country-by-country data is not trivial for firms to do, because if you think about a multinational entity that operates in, let's start with a very simple example of a company that operates only in Germany and France. Then, for instance, it's very simple to allocate the profits to either of both countries. It's going to be a bit harder if you consider, for instance, permanent establishments, and it's going to be far more harder if you consider more and more countries with subsidiaries with permanent establishments in different countries, especially if the reporting systems in those other countries tend to differ stronger, because it's probably very easy for a company to disentangle the profits that are reported in Germany versus France, because they have very similar reporting systems. It will also be very easy for the US, but it will probably be much harder for Chinese firms, for instance. Also, in terms of how communication within a firm functions, because one might expect that the parent company always knows perfectly well what's happening inside all the subsidiaries, but that is in fact not really the case, and that is especially not the case. For instance, for China, that is an example that I took because I spoke about this with a practitioner, a tax advisor, who mentioned this as a specific example where it's sometimes really hard to get the information from one's own subsidiary if it's located further away in a very much different system. And so the requirement to aggregate the information, these financial information on the country level, is not necessarily easy for firms. And that would mean, or what one might now expect, is that this new requirement requires firms to change their internal information flows, their structure internally. For instance, the communication between the parent and the subsidiary, or across departments within the parent company, stuff like that. There probably have to be changes, at least for some firms. Those changes will always be costly. That is why this is interesting. It is kind of a side effect of, or would be a side effect of country-by-country reporting that is not directly related to what the regulators wanted to do. And so what we hypothesize is that there could be effect in either of two directions. The most straightforward thing would be that companies improve their information structures according to the additional requirements, and then are better able to follow the additional requirements. On the other hand, it would also theoretically be possible that firms fail to meet these requirements, either because they, for instance, don't consider them very relevant, or simply because the the newly introduced requirement creates additional risk sources that have to be incorporated in one's assessment of the strength of internal information flows. So there could be an effect in essentially either of two directions. And the research question now that we want to examine is how then the introduction of CbCR changes the quality of internal information flows within a firm. How do we measure this to make it a bit more reachable? That is essentially what it's called in the title of the paper, internal control systems, the quality of internal control systems. Commonly used proxy for the quality of information flows. What is internal control? It's essentially the set of rules and mechanisms that ensure that financial reporting, the operations, and the compliance within a firm function efficiently. You may know the COSO framework, which is the prevalent standard for assessing the quality of internal controls. And in the United States, which is, as I mentioned, the setting that that we are evaluating, there is a very, very famous act that is the Sarbanes-Oxley Act of 2002, and in this act, in its section 404, it is prescribed that companies, or that the management of a company assesses the effectiveness of these internal controls very broadly in many different aspects. And then this assessment of the effectiveness has also requires to be audited by the external auditor of the firm. And so the audit does not relate directly to the internal control system, but to whether the management's assessment is done appropriately. And so this allows us to, or this gives us a broad measure of the quality of information flows. One main advantage of using internal control systems is that we can differentiate different types of internal information sources. In our case, tax-related internal controls and non-tax-related, so everything that is not tax-related, because what we would expect is that since country-by-country reporting is mainly perceived to be a tax-related disclosure mandate, that any amendments that a company would do to its internal structures would primarily also relate to information flows in this area related to the tax function of a firm. And so this is what we examine. We use a sample with financial data from Comcast and Audit Analytics. Audit Analytics, great source for this, allows us to have all the data we need on SOX section 404, material weaknesses in internal controls. It pre-codes different types of internal control weaknesses. So we did not have to do this manually, go into the 10K filings ourselves and check whether the problems that are reported are related to taxes or not. So this has been done for us. As I mentioned, we use US data on multinational entities. The approach, the empirical structure essentially follows Yoshi 2020. We use M&Es, we use a difference in differences design, where we exploit the revenue threshold of the introduction of CbCR, that is 850 million consolidated prior year revenues, and a post indicator, of course, for the introduction of CbCR. I mentioned already that we differentiate between tax-related and non-tax-related internal control weaknesses, and we would expect any effect to be at least more pronounced, maybe only occurring in tax-related weaknesses. Our full sample with these minimal restrictions on data availability is about 7,500 observations large. Actually, for most part of the analysis, is a bit smaller because of potential quasi-separation that may be an issue, or that would be an issue, since we use logistic regression models. we use plenty of control variables, known determinants of internal control weaknesses, really, from prior literature. We use industry and year fixed effects, cluster standard errors, everything as usual. Now, this slide, I don't want to spend too much time on, just to put this up here to show you that we thought about this. The issue of maybe lacking pre-treatment balance. I differentiated it here for non-tax and tax-related internal control weaknesses. And if you now say that, okay, there's no clearly observable trend, then I totally agree with you. It's not a perfect representation of what we hope to find, but I think one can see very broadly that there probably is, or there may be some effect over here. I'm not sure if you can see it very well. The control firms are the blue ones and the treated firms are the red ones. This is plotted in 6 month steps. And so I'd say there is no clear effect for non-tax internal control weaknesses. There's also, of course, no clear effect for tax-related internal control weaknesses before the treatment starts, but there may be after the treatment starts. But I agree with you if you say that this is not very convincing. I hope to do this a bit more with our regression results. Also differentiated for tax-related and non-tax-related internal control weaknesses. What you can see here is a clearly negative effect. I also plotted this here on the right-hand side with the predictive margins for treated and control firms before and after the reporting. What you can see again here for non-tax internal control weaknesses, no clear time trend, and especially no difference in the time trend between treated and control firms. This is very much different for tax-related internal control weaknesses, where the likelihood of a weakness declines substantially after the introduction of country-by-country reporting. So this would be consistent with CbCR resulting in reducing the likelihood of internal control weaknesses or being related to better internal information flows. If you still do not find this convincing, I also brought you some robustness tests. First, essentially a set of falsification tests exploiting the both indicator variables for the treatment group and the treatment period. I use 1 year before and after the treatment as counterfactuals, and also 3 alternative revenue thresholds. And what we do essentially is we loop over them all. So we have like 12 iterations. The only one where our findings are significant is the factual specification, which is good for us. What we also do is we assess covariate imbalance, the potential issue of covariate imbalance, because of course our treatment group is based on revenue, so it is a highly imbalanced treatment control group. This is a problem we cannot really get rid of. So we try to stick here with the approaches that were done in other studies as well. And we use entropy balancing and inverse probability of treatment weighting as 2 mechanisms to like reduce this concern. And our results really just continue to hold. They somewhat tend to be even stronger for entropy balancing. But that's good for us, right? And a third thing, as I mentioned, we use logistic regressions, which could always lead to the problem, since we have a rather rare event, because tax internal control weaknesses only occur in like 1% of the sample in total. The problem that could occur here is that we have a bias in our estimation with a logistic regression. So what we do is we use Firth's maximum likelihood estimator, which is which includes a penalization term to the score function, and has 2 great advantages. First one being that it prevents very effectively this bias, and at the same time it's allows us to handle the issue of quasi-separation. So we can at the same time check whether our sample reductions that were necessary to include industry fixed effects at least affected our results, because now we can use the original sample of 7,500 observations, and in all of those specifications, our results continue to hold. So now just some additional notes on further tests that we did, just to give you a bit of a better feeling about the data set. We also thought about the possibility that our results mainly or simply reflect upgrades to internal control systems. If you consider a steady sample with observations that had material weaknesses in for instance, 2015 that got rid of those problems in 2016, then these firms are less likely to again report a material weakness in 2017. There is empirical research on this. This is actually the case. Since we require firms to have observations both before and after the treatment, this may be a mechanical reason for our results, that the likelihood just declines over time. And what we actually see is when we just plot this, that the likelihood for firms to report a tax-related internal control weakness in the treatment period, if it already had one before, is essentially zero, or at least lower if we consider internal control weaknesses in general. Of course, there's no perfect way to really handle this, but we try to do this in the regression by including an additional indicator variable for those recent control upgrades in different specifications, like 2 years before the treatment, 1 year, 3 years, whatever. And we include this together with an indicator variable for being in the treatment period or not. And our main results still continue to hold in this case. I know that this is not a sort of perfect design here, but it's the best that we got because we cannot include any more indicators for this just because of lack of observations. And the last thing, 2 minutes, great, is very, very simple again, form of sample split to check whether how our results behave cross-sectionally. What we wanted to observe is whether our results are just an effect that occurs in all firms essentially, or that could be in all firms in our sample, or whether they are specific to some companies, in this case, especially related to the tax strategy. And what we do find is when we split according to tax aggressiveness or to tax accrual quality, based on the measures of Balakrishnan et al. Or Chowdhury et al., we find that the results prevail in tax aggressive firms and in firms with low quality tax accruals. I have to admit that this is not a final version, because there are probably many more interesting aspects that one might have a deeper look into, for instance, regarding the geographic dispersion. This is something that we have on our agenda, but we're not yet able to incorporate here. So just as a teaser for future versions of the paper. This leaves me with a conclusion to the paper. We, as I showed, we examine how the introduction of country-by-country reporting in the USA affects the likelihood of firms having to report material weaknesses in internal control systems, both for tax and non-tax issues. We find that this effect only prevails in tax-related material weaknesses, which we interpret as at least consistent with firms having to improve or being able to improve their internal information flows due to country-by-country reporting. But at the same time, something that has to be considered is that there is really no way that this improvement in information flows occurs without a cost, because it has to come from within the firm in this case. So This is what I mean here by investment intervention, which is essentially what CbCR is from this perspective, some way where the regulators force companies to improve themselves. That being said, I want to thank you very much for your attention and look forward to your comments, questions, and discussion. Yeah.
Hi, so Till, obviously you've done a lot of empirical analyses in this paper. So my question is a little bit more high level, and it's about your argument about how country by country reporting can actually compare the internal control quality. And you didn't talk too much about this in your presentation, but in the paper you mentioned how exposing an internal control weakness would be evidence that it impairs internal control quality. But I kind of felt like that would actually be a good thing. That would be a way of giving the firm an opportunity to remediate the situation. But I was thinking of reasons how country by country reporting could actually impair internal controls. And maybe one way could be if it adds a lot of complexity to the communication structure, to the entity structure, or if it adds like new employees or some kind of other way of complicating the organization, then that could be one way that would actually harm internal controls. And I noticed that some of the control variables that you have in your regression, like like turnover or change in auditors, or maybe even auditors provided tax services, those could be potentially used even as dependent variables to see, well, does CbCR actually cause firms to add more complexity, change their auditors, do something else that would increase your complexity. So anyway.
Yeah, these are very interesting comments. Thank you very much. I also, well, regarding the theory, I just want to react to this very briefly. This is a very interesting idea that I did not really thought about. What was in the focus of our argumentation for the impairment was, as you mentioned, mostly related to like really reporting aspects. It's not the control system would actually be impaired. That is true. As you mentioned, it would be more like companies being forced to having to report such a weakness. So this is a very great point, because it's probably minor flaw. But I like your thoughts on what else would be plausible reasons for impairment. So I have to think a bit more about this, but those are very great. Thank you very much.
Exactly. And when in the US firm is being questioned by the US Securities and Exchange Commission, the correspondence between this commission and the firm is uploaded on Edgar. And if you search, there's no mention of country by country reporting in any of that correspondence. But your paper is about the PCAB. And so I think it would be great to have an example, just one. So call up the PCAB and ask them about the link that you're hypothesizing, because they, as a regulator, who are separate, although somewhat under the SEC in the hierarchy, they might have a specific version of that channel that we haven't thought of. Okay. And so the regulator can help. They can request it as Freedom of Information Act, but you can also just call them up and say, hey, I'm this so and so, and they in fact want to engage with researchers and have an annual conference on PCAB matters that they care about. So they can help you leverage the argument about that specific channel that you are hypothesizing. And just one example from them will give you a lot of credibility.
Okay, great. I didn't think about that. Thank you very much.
Cool, thank you. Sorry, we're out of time, so let's move to the next paper. But I see there are some other questions. We keep that for the copy break. And we have, so thank you.
Thank you very much.
And we have Julia as our last presenter of this session.
Thank you. So, hello everyone. I'm going to present something that I think will complete the presentations that we have seen earlier today. And we're going to talk, we have heard a lot about how country-by-country reporting data is adding new information and it's very useful. And here we are going to explore a bit more which are the issues that we might find in this data and try a bit to quantify them. So this, I would say, is the first phase of a larger project that we have together with Manu at the Tax Observatory, where we are cooperating with the Italian Ministry of Finance, with Paolo Ciari, Andrea Santomartino, and Barbara Bratta from the GRC. As was said this morning, this data offers many new possibilities and it's very complete. We have detailed geographical disaggregation and overall we have new information that is added thanks to this. But one thing we didn't really talk about is some issues that are there in this data and might limit the interpretation of the findings that we have, in particular, double counting of profit. So here in what I'm going to show you in this first stage of this project, we're going to try to understand a bit more which are these limitations and provide a methodology to benchmark the data. We're going to use consolidated accounts for this purpose. And we're going to provide some estimates of the double counting that we might have in profits. And just to give a preview of our results, we will find that double counted profit amount for about 22% of the overall profits in our sample. So first, which data are we using? Thanks to this cooperation with the Italian ministry, we have access to the universe of country-by-country reports that are submitted to Italy, so a bit similar to the setting that Florian has for Germany. So compared to the overall universe of country-by-country reports that are out there and that are reported from the OECD, we cover, of course, 100% of the CbCRs in Italy and about 50% of CbCRs of other European countries and the US. And finally, we have very limited coverage of country-by-country reports from Australia or South Africa, so countries where Italy might have less ties. So for our final sample, we do some data cleaning. Of course, we drop firms with incomplete information, duplicates, and we also need to do some corrections. For example, we can find some mistakes on the TIN, on the names of the company, sometimes on magnitudes and signs, and we end up with a sample of around 2,100 multinationals. You will notice that in 2019, we have less information available, and this is because we're waiting for the second batch of the data that is going to be complete. So what are the issues with this country-by-country reporting data, in particular related to double counting? So first of all, the data to be constructed by the companies is aggregated. So for a subgroup, to obtain the value, we're going to sum the financial accounts of all the entities that are active in a country. So we are not going to eliminate all the intra-company transactions that happen in the country. And second, for the fiscal years before 2020, there was no specific indication of eliminating intra-company dividends. But this issue is only temporary, and guidance was issued in 2019, so this will be resolved from 2020 onwards. But unfortunately, we have these problems for the years that are available, and we need to find ways of correcting for this double counting, or at least understanding how it might affect the results using this data. So what do we do? So just to explain the issue more in detail, especially for what concerns the inclusion of intra-company dividends. If we have a parent company A with a subsidiary B, and this subsidiary B is distributing dividends to the parent company A, we will have, first of all, multiple counting of profits if these are included in in parent company A. And second of all, we have a low effective tax rate in parent company A because these distributions are usually taxed with a very low rate, as they are distributions of after-tax income. So what do we do to try to understand if there is some double counting in this data? We compare the CbCRs with the consolidated accounts from Orbis. And why do we do this? Because in the consolidated accounts, the multinational group is treated as a single entity. So all the intra-company transactions are eliminated and there is no double counting. So how do we proceed? We focus on two variables, unrelated party revenues and profit. And we first match CbCR data with Orbis data. And then we compute a ratio between the CbCR aggregated amounts and the consolidated figures at the multinational level. We then use this information to calculate double counting profits for those firms where we hypothesize that the dividends are included, and we calculate the amount of double counting as the difference between the CbCR amounts and the consolidated amounts. So we start first by matching CbCR and Orbis data. This is quite a challenging process. We use the tax identification number or fuzzy matching on the company names. But as you know, there are many issues and this results in partial matching. So overall, we can match a little bit more than 70% of the companies included in our sample. Going to the ratio between the CbCR and the consolidated accounts value, we can see that for revenues, the match works pretty well. And the relation between the two is about 1, which means that there is almost an exact correspondence between the two values. When we turn to profit, we can see that the ratio is larger than 1, which means that in CbCR data, we have a higher profit as compared to the consolidated accounts. So this is suggesting that there might be some double counting in the profit variable. What do we do with these ratios? So basically, we want to divide the companies into 3 different groups. We're going to assume that if the ratio of revenues is close to 1, the match is pretty good. And so we use these 2 groups and say that if the ratio with profit is larger than 1.5, there is a possibility that dividends might be included. And when the ratio is smaller than 1.5, most probably dividends are excluded. We then have the third group where the ratio with revenues is not as nice as close to 1. And we exclude this group for the analysis. We're going to show them for completeness, but we don't rely on this information to estimate the double counted amount of profits. So putting this into a chart, you can see between the 2 yellow vertical lines, the ratio of revenues. And these are the companies that we take into account for the comparison. Above the red line, you have a profit ratio that is larger than 1.5. And there we have about 30% of the observations. Below this, we have the companies that most probably exclude dividends, and this is about 62 of the observations, so a larger part of the multinationals included in our sample. Finally, the gray dots, which are the dots where we assume that the matching is not as good. We have about less than 10% of the observations. So now we want to understand whether our hypothesis is correct about the inclusion or exclusion of dividends. And for this, we are going to look at effective tax rates. So as we said before, if dividends are included, we expect a low effective tax rate. And here you can see that for the first group, the effective tax rate on the median is about 20%. And for the group in the middle, which is where dividends are potentially included, the effective tax rate is slightly higher than 10. So this confirms our hypothesis that companies in the central group potentially include intra-company dividends. We then look at the same statistics for the ultimate parent of the group, as we expect that the ultimate parent will receive most of the dividends as it is at the top of the ownership chain. So here we can see that also in this case, in the central group, the ETR is lower as compared to the first box plot where we have companies where dividends are potentially excluded. So now we ask how much do this double counted profit account for, especially in, we start from looking at this at the M&E side. So here, as I said, we calculate the amount of double counted profit as the difference between CbCR aggregated values and the consolidated figures. And what we find is that this double counted profit account for about 60% of the group profits, and this across the different years. We then try to understand how much across the overall sample this double counted profit might account for. And here we consider the multinational with a good Orbis match. So where the ratio is with revenues is between 0.7 and 1.3, as we said before, between the two yellow lines. And here we obtain that double counted profits in the aggregate are about 23%, 20% in 2019 and 25% in 2019. We then apply this percentage simply to the overall sample that we have to approximate double counted profit in the overall sample. So here we see that I will focus on 2017 and 2018, where we have the most complete data. Out of 3 trillion profits, around 700 billion are double counted. We then quickly compare the results with the literature, and they're quite consistent, especially with Horst and Kuntarolo, where we have 23% of double counted profit for the US in 2017, and also other measures from the governments that are provided together with the aggregated CbCR data. So to conclude, of course, CbCR are a new source of very valuable information, but there might be some issues that might hamper their use for economic analysis, especially when we want to look at profit shifting. So here in this work, we benchmark CbCR data with consolidated accounts to try to measure how much this double counting might be, and we find that about 22% of the total profits are double counted in our sample. Of course, we have some next steps in our analysis, and we will try to attribute this double counted profit to specific countries to correct the values, and then provide some more analysis with some confidence. So that's it.
Thanks very much. Any questions? Yeah.
I think it's so interesting, huge public service, this data. Do you have any sense, and I know you said you're about to do this, so maybe the answer is no. But do you have any sense whether your analysis will show what course will follow and the other side, which it seems to be that there's more double counting in the headquarters, like that's where it's showing up relative to foreign income? And also, I think there's kind of an interesting trend split in this that second paper, which I think is Zuckman and Garcia, the others, but where they showed it kind of getting worse over time, whereas you seem to have a more stable trend. I'm curious if you have a hypothesis about that as well.
Yeah, so for the countries where double counted profit might be more attributed, of course, there is the parent entity. But then what we see, for example, from voluntary CbCRs that are published, you can see that also countries where there is a lot of holding activities might be quite important. Like, let's say there is a company that has the headquarters in Italy, but as a big center for holding all the other subsidiaries in the Netherlands or in Luxembourg, or in the UK, like most probably you will find a lot of dividends also in these countries that are like these knots in the ownership structure of the company. So this is my hypothesis. I don't think that you will find, I don't think this affects all countries, but what I'm a bit afraid of that is that it affects countries like the Netherlands or Luxembourg, where there is a lot of holding and where we want to see whether there are profit shifting activities or not. So that's why we're doing all of this. And in terms of the differences, I think for the United States, in 2017, you have a lot of dividends maybe for repatriation. But in 2019, it decreases again. So maybe we need a few more years to understand. Yeah.
Are you optimistic that the clarifications will solve the problem in terms of the telling companies what to do, or do you think there's enough of them that just aren't reading these forms? Like, if you read the IRS form for this, it sort of looks like any company paying attention should not be done because they're pretty clear about what they want. So there's two possibilities. Like, one, they didn't have good instructions, and then you have better instructions that can do better. And two is they're never going to pay attention to the instructions and they're always. And I was wondering how. Yeah.
So I am kind of optimistic, but like for sure, yeah, I don't know when we will have access to 2020 data, but I for sure would redo this analysis to double check and not blindly. Also because this can be like a confounding factors, like sort of something companies can maybe use to say, no, the data is not reliable because there are dividends. So yeah.
Yeah. On that point, pretty often there's the options like they're doing this on purpose, right? Yeah, but then if that's the case, then are those like multinational companies there in province or are like is there something special about them? Or do you?
Not for the moment, but I think we should look a bit more carefully. So there are some country patterns in the way in which also you interpret the law. Because, for example, for some countries, so the guidance was clear for revenues. So for revenues, it was very clear that dividends should be excluded. But for profit, basically the guidance said nothing. So some countries have a very legalistic approach where basically if it is not mentioned, it means that it's included, especially because it is mentioned in revenues that they should be excluded. While other countries have different interpretation of the law, and they basically interpret it as if in revenues it is excluded, then of course also in profits it should be excluded. So there might be a pattern depending on the country and how the law is applied or interpreted. But it would be interesting to see also different patterns across multinationals that include or exclude things.
Right, we do have a few more minutes if there are any other questions.
Yes.
Yeah.
Kind of a follow-up. I don't know this too well. So is there any auditing of the CbC data? Do the tax authorities double check? Is there any penalty for misreporting, for instance, in this case, that they over exaggerate dividends?
I think it depends a bit on the country. For some countries, yes. For some countries, no. So, but in this really double counting case, as the guidance is not clear, it's I don't think you can have a penalty because of this of this reporting.
Any other questions? If not, then yeah, let's go to the coffee break and meet here in 17 minutes for the policy panel. So while we set it up, the coffee break again is in the next room. Yeah, thank you.
Thank
Cool. Exciting. Yeah. And can you last? So, but from 2000.
Hotsava was so kind that she accepted the invitation to chair our policy panel, and she will be in charge. But I want to, very much appreciate that she took the time to, stop investigating the many cases that she has won many journalistic awards for, and stop by, and we will be moderating the panel on transparency and country by country report. Thank you.
Welcome. So I'm very happy that I see many eager faces to learn today about the risks and benefits of corporate transparency. I have my great colleagues who are going to discuss this issue with me. First of all, disclaimer, I'm a journalist. I don't know anything about reporting on a big amount of data, anonymous data regarding tax transparency or tax in general. So I may have some silly questions. So guys, please just answer, don't point it out, okay? And so let me introduce my guests. I'm Gary from Tech Coalition on my far right, sounds good. There's Jean-Philippe Rabin from France, could I say it in English? Could you introduce yourself?
Yeah, of course. I live in Brussels, actually. I'm a French national citizen, indeed. I work in the corporate reporting unit in DG FISMA. It's the let's say the acronym for the Director General that works in the financial services.
European Commission. Okay. Can we just stick to European Commission, please? For my benefit.
Sorry.
So the next one on my right is Jiří Valenta from Czech Ministry of Finance. Welcome.
Thank you very much.
And on far left, it's Vito Furnari from Italian Revenue Agency. And because you all know much more than I do about taxes, I will skip, to introduction to the topic we are going to report or talk about, what is country by country reporting, the new and fascinating tool that may be able to reveal how in EU we have a black zone and gray zone and white zone regarding taxes, and how the multinational corporations, I am not mentioning Facebook or Starbucks or those companies, are actually aggressively planning their taxation so they don't need to pay the taxes almost at all. Because we are going to talk about the risks and benefits. And I'm a journalist, I actually have no idea what could be the benefits of not revealing who's paying what kind of taxes. Anyway, I will start with you, Vito, if I can. So what could you tell us, and how do you see the new reporting standard and what kind of information it can bring to general public like me?
General public, let's say that first of all, good evening to everybody. So let's say that for the public, I don't see, frankly speaking, that is or could be so incisive and let's say useful, because if we have to distinguish the political side from the administrative side, now they are saying the tax administration, so it's another question, then I'll actually respond. But let's speak first about the political side or the moral side. In this case, maybe the publication to make this data public could be useful, but just because it can have just a deterrent effect, but not a direct effect in covering the tax gap. Because the question is much more complicated than just reading this data, just publishing this data. Because of course you start saying, I'm not a specialist. I have to say, treating every day, working every day this data, that's quite complicated to understand something. Because you can just see a picture, you can just see that, for example, there is an high risk or later a low tax jurisdiction, and that the group is working there. But in itself, this can mean everything and nothing. It depends on the context and depends on the business model. It depends on a lot of variables that you have to take into consideration. So what is the risk? The risk is a big misunderstanding.
Okay.
The risk is that maybe we could also pose in risk the reputation of a multinational enterprise. This is the risk. But from the other side, of course, the, let's say, availability of data from the other side can help transparency, of course, and can have a positive effect in terms of deterrence. Then another aspect is the operational level, because as tax administration, I have to say that CbCR data coming from the automatic exchange of information are really, really useful for us. Even if it's a tool that is not, let's say, complete, but there is much work to do on this for sure, because information are not enough, information are not completed. The quality of data so far is very, very low, but it's a very good starting point. In fact, we have implemented a process for treating this data in the right way. When I say right way, means from one side, protecting the confidentiality of this data on behalf of the companies, but from the other side, exploiting as much as possible this data for risk assessment. And when I say risk assessment, this is not a bad thing for a company, because we have to understand that when I perform a risk assessment, I can select a company, but I can deselect another company, because I can have just a better understanding about the business model. Then in Italy, we are used also to have an open discussion with our taxpayer, large business taxpayer. So for example, if there is something that doesn't convince us, we cannot go directly to a chat to challenge the topics. No, absolutely no. We open always a discussion with our taxpayer in order to understand what is going on. Once again, because it's not absolutely easy to read immediately a country-by-country report.
So can anyone explain me how does it look like? The report.
Yes, the report, let's say that the core is a table, no? It's a table, the famous table 1, in which we have a lot of data, economic data, coming from the financial accounts or internal accounts, and mainly you have internal revenues. For example, you have revenues with not related parties, then profits, then taxes you have paid, accumulated earnings, stated capital. So you number of employees. So what is important is that you can have just in a jurisdiction, for example, an immediate view of the balance between investments in terms of assets or in terms of employees and economic results. For example, in Italy, we have implemented an IT tool for the automatic treatment of this data in order to have automatic evidence of something that is not working very well. So it's a tool that elaborates all this data based on 5 risk indicators that we have elaborated internally. And at the end of the process, you have flags, red flags, saying there could be something wrong in this group, and specifically in this jurisdiction. This is just to focus the risk assessment, just to avoid the so-called fish expedition, no? Or just to focus our resources on cases that could pose real risks. And the first and then probably the most important indicators is the one we call indicators of asymmetries. Asymmetries of what? About what? About assets, employees, accumulated earnings, and economic results. It's clear, it's evident that if in a jurisdiction you have low assets and few number of employees, but you have a lot of income and a lot of revenues and low taxes, there is something wrong. But the real change, sorry if I'm going to practical, no, because I want to say what we are going to do. But the real challenge is this one. When we have intercepted, for example, a risky jurisdiction, okay, let's assume one in the world, I don't know, Bahamas or something else.
Vanuatu, it's my favorite.
Italy, what. The problem is, okay, we haven't accepted that there is a very high risk in that jurisdiction. But then the real challenge is what we can do as Italy. What we can do, because this is not so easy. One, we haven't accepted the risk. The real problem as tax administration is how to couple it, how to counteract it. And the answer is that in many cases, there is nothing we can do. This is the real problem.
It's like
you know why?
5%
You know why? Because sometimes, for example, there are no direct transactions between Italy and that jurisdictions. This because a lot of times that is the result. The fact that the income is, let's say, allocated in a low tax jurisdiction is just the effect of the big schema involving many countries. So the question is, and the key word is cooperation, international cooperation. We are understanding from this work that if we don't rely on international cooperations in terms of practical results, there is few that we can do. This is why, and just to summarize, CbCR is a very good source of information. In any case, not in itself, because it's always necessary to combine this information with other sources of information, raw and like internal tax return, whatever you want. But in any case, it's necessary to use properly this information and sometimes to have interaction with other countries, with other jurisdictions, in order to rebuild the old pictures, the old schema. You are a journalist, you understand very well what I'm saying. You cannot act alone. You know, if you want to fight international, let's say, avoidance, international, let's say, yes, evasion, we have to act internationally, to think internationally too, globally. This is my
very brief.
Sorry. I don't want to take the floor for
no,
so long.
Thank you. Let's move to another question, and it's for Ian. So, would it increase tax transparency or not?
Right.
The country by country reporting standards, and we are talking about EU, so I guess the answer is negative.
Well, in terms of increasing tax transparency, the EU country by country reporting is a half step forward. That's for sure. Because of its limited nature, the fact that it's only applying to EU countries and gray zone countries, that's problematic. And obviously, the campaigners that the FACT coalition worked with in Europe wanted to see full public country by country reporting. But the fact is, it's a step forward. And it's, I think, in terms of the long march of history towards tax transparency, it's an important step. And we're seeing other signs of global momentum right now. For example, it was mentioned earlier in the conference that Australia is actually moving forward with full public country by country reporting globally with no jurisdictional exceptions. And I think that's an extremely important step.
How are they going to do it?
They're going to put in place regulations. I mean, they've announced it in the government's budget last week. So the full technical aspects will have to go through Parliament, but we're expecting strong public country by country reporting rules to come out from Australia. And that will be the first time, for example, that a multinational, like an American multinational like Microsoft or Exxon, hopefully will be captured by these rules and will be forced to disclose their information to the public. And so that disclosure could happen as early as 2024. We're also seeing important signs of progress in the US. The chairman of the Securities and Exchange Commission, Gary Gensler, has said that regulatory body is looking into establishing public country by country reporting, which could happen without any action from Congress. So there are some exciting movements, including on the corporate side itself. And so a lot of companies are indeed resistant to disclosing information, but there are some companies who have made a journey from, for example, Shell. I remember like 15 years ago talking to Shell, and the answer was basically, over my dead body, will you get this information? And to today, where Shell is championing the fact that they're voluntarily disclosing public country by country reports, and they're telling the public that it actually doesn't cost that much, and it builds value
Reputation.
and trust and cooperation with different stakeholders in society. So I think we've actually come a long way.
So finally, we are heading in the right direction. Okay, still not there.
No.
Okay, thank you. So you consider this step like really important, really breaking point, or just, finally we found a way how to do it?
Well, I think the conversation has gone from whether we'll have public country by country reporting to when we'll have it, how deep it will go, and how quickly that progress will be made. So I think that's an enormous shift in the public discourse.
Okay, I have a question to Jean-Philippe. So why EU or European Commission decided to make this reporting public, or why? Well, that's actually a silly question. And
Wait, no.
Because
well,
why?
Because we did not really decide to make that information public. I mean, there's a big hurdle in the publication of that information, is that in the exchanges treaty between the tax authorities, like Vito, and for the cooperation, there's a clause that says that these reports must never be published.
What is it?
So that's a big
can you
problem.
read it to me?
So that was the premise on which the Commission, by the way, made its proposal for the directive on administrative cooperation back in 2015 or 16, and on the basis of which EU companies are reporting this report to people like Vito, but Vito keeps that for himself. He doesn't publish it. So what do? We are not publishing this. So at the same time, in 2016, the Commission made a proposal because recognizing that there was an element of public trust in the
quite a huge
tax
element,
system.
maybe?
Yeah, exactly. Just like, as you say, well, what are they doing? Are they paying taxes in my jurisdiction? We made a proposal to have some elements published, but it was a different basis. It was a different legal basis, different objectives than this report that is now filed by the companies with the tax authorities. So what are the objectives? The objective is not to make any EU citizen turn it into a tax auditor and enable to decide that the company is not paying enough taxes, because just as Vito has said, it is extremely difficult to analyze, and you need to do other things than just read a country by country report to know whether the company is complying with the law, the tax law. But the thing is that it's important for people to at least have a clue how much tax is paid in the country where he or she lives, and to have some elements about that. But there were constraints on our side. The first one is that we have the proportionality objective and constraint, which means that okay, you can have the nice to know, but the proportionality principles tells you that you just have to make public what is needed, what you need to know. And what you need to know is, of course, the key elements that will enable you to assess whether there is a fair amount of tax paid, like the profit before tax, turnover, and let's say employees and certain elements, but not necessarily all the elements that Vito has in hand. And another big issue, and also people don't realize that how much constraints it imposes, is that the proposal that we made is to have a global reach. It was not just for the EU companies. We said that each time a multinational is setting step in the EU, like Starbucks or whatever, it should provide information on how much taxes the company pays in that in the EU. not
the EU.
everywhere, because
the
we
EU.
are working for the European citizens here, so not for the
Not for
US
global
citizens
citizens.
and Australian citizens. So that's a bit of a constraint as well. So with this global reach, it means as well that if you want to have information about what a multinational, which is not an EU multinational, is doing, you need to consider why do you need that information. If you want to know what amount of turnover Starbucks is doing and how much taxes Starbucks is paying in Australia, why do you need to know that? Australia is not known for being a tax haven, right? So what is the EU citizen doing with this information? Why force? Why force? Because we are speaking of law, third country companies to do that. So there was an element which is also legal about a link to the EU policy. And finally, there were other constraints like the competitiveness of companies, because we received companies who were saying that this information is very sensitive, whatever, etc. So so it also has to do with the need to know basis. So basically, we have come up, and we have to accept that, with something that looks like the country by country reporting, but it's not. It's a separate policy, even though we have put in the directive that if a company publishes the tax CbCR, de facto they would comply with this EU. They wouldn't comply with the EU report, but they would provide more information than what we will be asking, in fact. And this report, this public report, is going to be a reality in a few years' time, because member states are now transposing the directive. It has been proposed in 2016, the directive, and it has been adopted only late last year. So there are some difficulties to adopt it.
So who is the strongest opposition to this? Is it country or company?
Well, there have been both, I would say, especially third country companies, which are not, for all of them, used to publish even their financial statements. That's a private.
Like at all?
At all. Only.
Where are they based?
In the United States, for instance.
Well, you need to publish a lot.
Well, not in the United States. So if you're not listed company, you're a private company, only a few people get access to that information. This is
looks very
crazy
American.
From an EU.
Yes, I can testify. It's very difficult sometimes to understand what is going on the other side of the ocean.
And so the Europe is one of the most transparent jurisdiction.
Oh,
already.
I should be proud. Looking at you from US. So, okay. And I have now a question for Yuri. So what was the Czech position during these negotiations?
Well, thank you very much for that question. I'll
no worries, no doubt.
Yes, bring it on. Anyway, I'll make a short introduction. I'll broaden up the question a little bit, but first let me make a short explanation about me, myself, my position. As you can see, I'm quite young and I'm quite new also at the Ministry of Finance. I joined the teams just in January this year, basically 2022. After the elections, we had parliamentary elections last year, and we have two types of deputy ministers so far. We have sort of the one who are, sitting there, governments are coming and going, and the deputy ministers, sort of the line deputy ministers, they are staying. Then we have the sort of the political ones, and that's me and one other colleague, and then we have a capo di capi, the big boss, the minister. So that's a short.
Would be happy to be called. Cafe, I guess. Yes, guys, from Italy.
Sorry, small joke. Anyway, move on. So I'm there from the January 2022, and as I said, I'm the political deputy minister, and I'm from the Pirate Party. So to get to my point is that my position is a little bit like double-sided. Pirate Party, I know that there's plenty of people from plenty of different countries. Pirate Party is the pro-transparency, anti-corruption party established about 10, 12 years ago. And then we have the Ministry of Finance side, but the Ministry of Finance, I think, is First, it's one of the biggest ministries in the Czech Republic. It counts more than 1,000 employees in the ministry, not taking into account the tax administration or the guys from the customs. And then also it's basically the sort of, I would say, conservative. So to your question, as it was said by Jean-Philippe, that it started in 2016, and yesterday I went down my way down to archives, and I looked about the letters and the positions which were published, and actually about 2 or 3 years ago, the Pirate Party actually intervened or sent letters to the then minister to ask, like, what's the position, what are the problems, where are we standing, and why. And first they were fairly negative, and then I can imagine. Then the position changed to the neutral, and yes, then this is the point, because there were some questions about as it was said, there were some questions about the legal basis, which should be the Article 50 of the Treaty of Function of European Union or the Article 115. Sorry, I see that I'm keeping up with the details. And yeah, so that was it. And the questions or the letters should I
repeat the question?
No. The letters which we got was basically as the Italian tax administration said, that there was this thinking about the disinterpretation or the misalignment, sort of. It was said that the European Union citizens are not able to make their own qualified picture of it from the available data and without the knowledge of the proper data. There was the question of administrative burden, which is, I think, very favorite argument. When you don't want to do something, put an administrative burden to it. Mm-hmm. And then there was also the question of the competitiveness of the Czech businesses or the businesses across the European Union in general. But I'm in a personal note, I'm glad that we have it, and I'm glad that we are, going forward with it. As, for example, not only the administrative cooperation, but hopefully even the pillar 2 of the OECD global tax.
Yes. This is a good point, because today we haven't mentioned so far also the possible connection between CbCR and the new regulation of Globe, because CbCR is considered also as a sort of, let's say, safe haven, let's say, in some way in the global regulations. So there could be an interconnections between the CbCR reporting and also the application of this new global minimum tax, let's say, so not just to simplify. And my question is, what will be the new fiscal landscape in the future if the global rule will be applied worldwide? For example, we can expect that there will not be jurisdiction with an effective tax rate lower than 15%. Yes, no. It will change something in the groups, in the organizations. I don't know. It's something that we should think about, because probably in 5 years, the world, the system, the international taxation system will change totally. And I think that this will have a very big impact also in the business model of the multinational enterprise.
In how many years? 5,
I think
15?
in 4 or 5. Depends, because in Europe, for example, we are still working for this new directive, and there is no total consensus. So frankly speaking, I don't know what to say, because we could expect in 2 years, in 2024, to have the first application, but I'm not sure anymore, because it's continuing, postponing. Outside of Europe, maybe Australia is going to implement it. I don't know, maybe UK is working hardly for introducing this rule. USA, it's already as a guilty or something similar. But in the rest of the world, I don't know But let's say that if the trend is this one, to introduce these new regulations in order to have at minimum the 50% of effective tax rate worldwide. And if this will be the reality, how the international tax system will change?
And how do you verify the information provided is
Oh,
correct?
this is always a challenge. We will see. Now, for example, in these days, during today, yesterday, we have been engaged, we have been engaged in the working power, OECD working party, and we are working just on the way companies, multinational companies have to declare this system because it's quite complicated. Imagine, it's like the CbCR. Imagine that for each jurisdiction, we have to report about taxation elements, adjustments, income, effective tax rate. So it's something complicated. My fear is this one, that the system will become too much complicated. And when you have to manage something that is too much complicated, it becomes not effective anymore. I don't want to be pessimistic because I don't want to, we have to be always optimistic. But frankly speaking, I don't want that the system will become something not manageable anymore. Because it's easy. For me, too much information equals not have information. This is the rule. Yeah, because when the amount of information is not manageable anymore, we are just overwhelmed.
Could I jump in there for a second?
Sure.
The idea that we have too much information about multinational tax practices, I just don't understand. And the fact that investors themselves are calling for more information about corporate tax practices. And I can give you a lot of examples. For example, in the US, legislation called the Disclosure of Tax Havens and Offshoring Act passed the House of Representatives. As the FACT Coalition, we were working with investors worth nearly $3 trillion in assets under management wrote to Congress asking for this law, which would require full public country-by-country reporting. And I think you described a scenario where in the next 5 years, we'll see significant changes to how multinational corporations are taxed, and I agree. The fact is, investors are flying blind into a coming storm, and they don't know how to value the companies that they hold. They don't know how to understand the tax risks of those companies. They don't understand how to value the geopolitical risks of those countries. And so that's why I think, you know, in addition to the stakeholders we've already mentioned, like the public, companies, governments, that investors are saying, we need this information to properly value companies. And that's why the chair of the SEC said they're investigating whether to do this. And I think, as Kim mentioned earlier today, in order to have efficient capital allocation and to make informed decisions as investors, you need this kind of information. And we've also seen, importantly, investors filing shareholder proposals with companies. And in the US, you know, you can, as an investor, call on companies to change corporate behavior and formally file a shareholder proposal. For the first time, the US Securities and Exchange Commission allowed a shareholder proposal on tax transparency to go forward. It was filed with Amazon in May, and 21% of the independent shareholders voted in favor of tax transparency at Amazon. If you understand how big Amazon is, that's a sizable amount of investors. We heard earlier about potential reactions of investors to public country-by-country reporting, but I think we're seeing investors using their own voice to say, we need this information, and we're far from a situation where there's too much information, there's too little information for investors to be able to understand the risks they face.
It's a good point. It's a good point, and I share this point, frankly speaking. But if we want to do so, we have to work strongly on the quality of data, because you have got a very important point. Of course, tax transparency is always another value, for sure, for everybody, for all stakeholders, for citizens in general, for investors, for politicians. But if you want to rely on this information, we will work strongly on quality. Because honestly speaking, so far, I cannot say that the quality is satisfying. there are a lot of mistakes, there are a lot of missing information. There is not, let's say, a non-homogeneous source of information because, for example, CbCR, you can use financial account, you can use another source of information, analytic accounts, or whatever you want. Doesn't work this way because, for example, we tried just to compare CbCR data with the financial accounts. It's difficult to find a match because, of course, you don't know exactly what is the source of data that are inserted in CbCR. So I got the point I share with you, but my message is and that we have to work internationally to improve the quality and to standardize, improve the quality and standardize the information that we insert. For example, there was a presentation about the jury before, no double counting, not double counting. For example, in some countries you have clear guidelines, in another country there are no clear guidelines. So cannot work this way. If you want to use CbCR for other purposes.
So is there any way, and that's a question to Jean-Philippe, that the CbCRs could be abused?
Yes, in theory, yes, I would say it's amazing to see that even a company that is providing information as documentation on transfer pricing to a tax authority is providing information that may not be reliable.
Yes, could be
all the time, but also perhaps because of different roles indeed. And, but the thing is that I don't think it could be done forever. I mean, there would be obviously, as you mentioned, attempt to recoup this information with the financial information at some point, and of course, if the profit is totally different, for instance, there's no reason to have, except for the dividend point that was mentioned earlier, but that there could be some double counting. Normally, you can match more or less the net profit. I don't think it would be in the interest of companies to do that because it's public information. It will be used by civil society, and if ultimately it appears that the company was cheating on this, of course, its reputation will go bust very easily. So I don't think it's in the long-term interest.
I wouldn't call it abuse, the public outrage.
Yeah, I agree. But the thing is that in the Commission proposal and in the directive that was adopted, the auditors have a limited role. They're not supposed to check the substance of the information, but they must check whether the company did publish the country-by-country reporting. So
they are actually giving a stamp on something that it's just saying, yes, we did, we published, and so actually it means nothing apart from the fact it was published.
Yeah, but I suppose the company will not publish a blank page.
Okay.
In Italy, we have some company that voluntarily disclose the CbCR. In any case, in Italy, we have a program that's cooperative compliance program, no, for very large business, large taxpayer, no, and company that join this program. It's a sort of continuing discussion with the tax administration. No? You have a preferential line, let's say so, no, for discussing with us, and a lot of them, of course, are big companies, multinational companies, also file the CbCR, and some of them decided also to disclose the CbCR on a voluntary basis because they think it's a good sign of to be transparent for their reputation and so on. So, but frankly speaking, we have to be careful in many cases in publishing, making public this data. Maybe something could be published, for example, could be interesting for investors and also for citizens in general, no, for politicians to understand just in which jurisdictions, of course, the group works, just, for example, the income and the tax they paid. It's enough. There's no need to disclose everything because information available are much more. Just the same necessary, just the picture.
Okay, so I will now ask Yuri because he's playing Tetris in the meantime. I'm kidding, sorry.
Yeah.
No, I want to.
That's what the ministers do, you know.
I want to ask you, we are in Czech Republic, Czech Republic has a couple of big companies. Was there any particular pressure from companies or from some party not to take this step?
Well, this is out of my reach, to be honest. But yeah, we could speculate that there would be some companies that would be against those rules. I mean, we checked that in the time of developing this legislation. By the available data, we used to have about 70 companies under the Czech jurisdiction fall into the scope of the public CbCR. And we can only speculate which one would be the ones against these transparent rules.
Maybe they will be all happy.
Yeah, I mean, I would wish for that, but I'm being skeptical in this sort of sense.
Okay, so and how do you actually deal? Are you anyhow getting ready for this kind of a lobbying or pressure?
Well, we're trying to. I believe that the Ministry of Finance in the sort of the experts role is doing their best not to fall under these threats of lobbyists and companies knocking on their doors.
Okay, so another question, I would find something for you. It's about your recent report. Are you happy to talk about?
I'd be really happy to talk about that.
You already started to answer because it's relevant to private investors being happy with this country by country reporting standards. So could you give us any kind of a, for me, probably I'm quite naive. I would say if I am investor, this would be my condition to really see the finances and the financial health of the company. So otherwise I wouldn't invest anything in such a company. So how does it work that, they don't get access to this information?
Well, I mean, if you're familiar, and as I think many of the people in the room are in the US with the 10K filings, that if you're an investor in a public company, you can go on the EDGAR database, Securities and Exchange Commission, you get some, corporate filings. And for tax, you usually see one bucket for US and another bucket for rest of the world. And that doesn't really give you any real information to understand the cash flow risks, the corporate governance risks, operational risks, geopolitical risks. And so we've heard from a number of different investors, as well as investor analysts like Moody's, that they really need to have this information in order to value companies and understand risks. And so I think that's a real powerful voice for public country by country reporting. The report that we just put out is called A Material Concern, the case for public country by country tax reporting. There are copies in the back. That lays out, the arguments. And I think, we've often talked about the tax risk arguments, but more recently, additional arguments relate to geopolitical risk. So with public country by country reporting, you will have a better understanding of the operational footprint of a company. And so, for example, McDonald's in Russia is one of the cases that we talk about in the report. Prior to Russia's invasion of Ukraine, there was relatively limited information. If you were an investor and say in January of 2022, as Putin was threatening and showing all the signs of invading, you wanted to understand how exposed McDonald's was. You would have not enough information to make that really a good assessment. What we found is that after the invasion, McDonald's did supplementary filings with the SEC to provide further detail about their operations, which if they had
Why?
done.
What was the motivation?
If they had done before the invasion, investors might have pulled out. And so what we were able to find is that there was a material decline in the worth of McDonald's related to $7.20 per share. So you can imagine, for example, if China is threatening Taiwan or many other geopolitical situations, that is another reason why a number of investors are asking for this information. We have now in the pipeline shareholder resolutions with Microsoft and Cisco, which are coming to a vote in December in the US. So I think this is a growing investor movement. And there's been a long history of some socially responsible investors looking at ESG factors, but really that talks about the E and the S and very little about the G, the governance of a company. We heard earlier this afternoon about some companies having very poor internal information systems, struggling to even understand or get information from subsidiaries. I think it would be very important for investors to understand which companies have such poor internal information systems, such poor management systems. That's a key indicator. And if it takes public country by country reporting to force companies to organize themselves in a way that any modern 21st century company should be organized, then let's do it.
Okay, thank you. I have a question for you, Jean-Philippe. And it's about, we are talking about, and I've read a lot of reports about how Europe is becoming old, not only by population, but attitudes towards the companies. So could this country by country reporting put European companies to some kind of a disadvantage on a global market?
That's what we heard in the beginning, and I would join Jan here to say that companies are complaining, and maybe after a while they realize that perhaps it's in their interest, and it's very interesting to hear that investors are asking for this. But back in 2016, this is not what we heard. So it goes beyond tax, if I hear you, because it's also about what kind of activities a company is doing in each country, and not just the amount of tax paid. So it goes beyond the mere objective that we had on our roadmap. So that's very interesting. At the time, we identified that we could put companies at a competitive disadvantage if, for instance, the EU companies were publishing a country-by-country reporting with all the information, and companies from third countries, US companies, were not. And then we didn't know at the time how many countries would join this scheme of a tax CbCR. It happens that it's a big success. Many countries around the world are exchanging this information. So they are bound a bit by another point that I didn't mention, which is that the tax authorities are asked by the exchange treaty to not misuse this information. So they are supposed to they must ask companies, but not use this report to do, for instance, direct taxation.
No, we cannot use this information. We can use this information just for the so-called high-level risk assessment.
Exactly.
High level means that we can have just a look, we can have just an understanding, but never we can use CbCR data, just that data, to issue an assessment. Never, because according to our law, this assessment is null in itself, legally null, nothing. So that what we do, we use CbCR data just to have an indication of the potential risk, but then we have to analyze more in depth using other source of information, tax audit, questionnaires, something else, because you have to give all very, very strong, tangible grounds for issuing assessment. So CbCR is not enough. It's just the starting point for performing an analysis and a risk analysis. So that's all.
So one of the risks that was identified with publishing is that
this is why I'm saying that that's tricky.
Tax authorities outside Europe could use this information against the companies directly.
I think it might be a good thing.
One of the issues.
I think it might be a good thing. I mean, the developing country tax authorities are currently shut out of the information exchange system. So in terms of country by country reporting, tax authorities in Africa, for example, have no access to this information. So if you wanted to make public country by country reporting, all of a sudden you have tax authorities all over the world digging into that information. And that's one of the things, like, as an advocate, I'm most excited about in getting this information.
Of course, we could do this through, let's say, an internal exchange of information, because let's say on the basis of that treaty, we can in any case exchange information. So for example, if an African country needs some information, could ask to Italy to exchange the information. In this case, I don't know if we can, but maybe we could. So I don't know if the right way is just to make all this data public, okay, to public all this data in itself. I don't know. I think that probably the question is to strike the balance between confidentiality and also, let's say, the necessity to give a better understanding to other stakeholders, like investors, like maybe other countries. No. Because I don't think it's a good idea in any case to give to the public all the information, for example, in this moment I have, my tax administration have. Maybe just an abstract something, I don't know what to say, frankly speaking, because it's a tricky situation, because I understand your point, I got your point, I share it. And from the other side, I know what is in my hand. And what is in my hand now is something dangerous. If it's not treated carefully, this is the question, because could be misunderstood. And then we have also not to underestimate the fact that actually a CbCR in the end of a specialist could reveal a lot of information that could be good for competitors. For example, if I look at table 2, I can understand table 2 shows on your real, say, for example, in a jurisdiction, I work with 2 companies, company A, entity B, and I have just also to sign what is the activity of this entity. So, for example, I can say that jurisdiction 1, Italy, let's assume, I have one entity that is just an IP company. So, for example, I can understand your business model. I know, and for example, if I compare one here to another here, I can understand that this IP company, say a company that belongs just intangible, has been moved from Italy to Hungary or to Italy from another state. I can follow your business model. I can follow also your strategic choices. Just to give you a picture, no? So it's something complicated, something that we have to manage carefully. But I understand and I share your point of view. We need to strike a balance. This is my conclusion, let's say.
Okay, so we have time, right? We have 4 minutes. Do you have any questions? I mean, you have unique opportunity to ask questions. Otherwise, I have, some backup questions on the list, but you may be, yes. I don't know how to do it with the video.
No.
Okay, just ask.
I have a quick question. So are there any countries that you know of that would be opposed to public CbCR? So for instance, if a country has, let's say, an attractive tax rate, would they fear that it would lose FDI or business from certain multinationals?
I have a couple of countries in mind, yes. Yes. The answer is yes.
Are they included in the discussion?
At least what we know is that Europe has been moving first.
In fact, so
then
far, I don't know. In
here.
Europe, yes.
Yeah,
Globally, I
Australia
don't
might join, US might join. I don't know. That's very interesting to hear. Maybe there's a kind of a momentum that is created. I mean, countries are not saying really that they don't want to do it, but they just don't do it, and that's
It's the usual way how
As a
they
matter
do it.
of fact, I don't know if right now there is a country that is probably making this data public right now. But as a matter of fact, so I don't know the policy, why, what is the reason. In any case, we are part of the EU, so we are following EU, and we know that so far it's just a discussion, there's just a discussion in place, but nothing concrete.
Yes.
Why was this threshold set based on revenue because it's going to catch a lot of companies for which the administrative burden is pretty large. Why isn't it set based on global scope, like how many countries you're in, or something other than that?
Well, if we read the OECD justification, they said that this with threshold, they were capturing 10% of the multinational companies.
Yes, it's just
90% of their revenues.
Of their revenues. It's just an empirical. It came up from a statistical analysis. There is no reason. In fact, every month we are back on discussing. Why don't you push down this threshold? Because political reasons. Because not to want to push where to make the burden, the administrative burden, all groups that are not so big and so well organized. So mainly the reason is this one, because they think that a group with a turnover that's below 7.9 million, it's assumed to be not well organized, so probably there are problems in receiving information and so on. And then the cost of implementing the system would be too high for this multinational or this group. So there are a lot of reasons behind this choice. But maybe could be changed. It could be changed in the near future, because there is always an open discussion on the threshold, especially if consider the global rule.
So time is over. I would like to ask you for warm applause for our experts, and then you can continue.
Thank you so much. Just a little bit of housekeeping. So the formal program, day one, is over. The informal program is starting. So we'll have plenty of time to continue the discussions. For tomorrow, we start at 9, again in this room. It will be locked, so you can keep stuff here if you'd like the programs or whatever. Today, Dan and Mike are going to continue guiding us through the city to the restaurant where we'll have a wonderful dinner. In compliance with the regulations of the funding, we will not be funding alcoholic drinks. So that's other than that.
It's like cool. No alcohol.
But of course, they will have. Yes, and so the guided ones, something else to 45 minutes. If you would like to join the walk, you should hurry up, and we will meet as soon as possible outside the main door. Because at 7, the first stop is the astronomical clock.
Let's try to meet outside of this building, and let's meet at like 5 to 7. Yeah, in 7 minutes.
Conference.